So let's begin, guys. Let's start off. The agenda for now is, first of all, we're going to be taking up the CA Inter May 2025 RTP for DT, alright, and then according to the available time, MTP1, the MCQs at least I want to try to finish for you, okay? So let's begin. Let's start off question by question. I hope you have already downloaded the RTP from your ICAI website, alright. I anyways have it over here, so I'll be referring to this one. I hope you can download the RTP from your end as well, alright. So let's begin, guys. Let's start off. We have some nice good questions. The reason why I am doing the RTP first before the MTPs is because RTP has very good questions this time, especially in DT, guys. Questions which we've never seen before. Very interesting adjustments they have asked in the RTP this time. So that is why we're going to start off with the RTPs, alright. You ensure that you keep the participation nice and high. Keep giving me answers in the chat box so that we can be confident that yes, we know the concepts, okay. And at the same time, if there is some new learning here and there, will you get disappointed? No, your mindset has to be, give me as much learning as possible before the examination. Okay, guys, so don't get disappointed if you have some new learning here and there. Alright, so on that note, let's begin, guys. Let's start with the case scenario over here. It's a nice case study based MCQ. There are some 5 questions under this one question, guys, and there is a certain technique that I always tell you to follow when it comes to case study based MCQs. If you've attended the workout batch or if you've attended any of my batches in the past, you must have seen that I always read the para, and when I read the para, I do all my analysis. I've shown you how every time whatever information they've given to us in the story, it's always relevant, guys. It will always have some use or the other. It will always be relevant. So as you read the story itself, you do all your thinking, you do all your analysis, so that when you actually come to the questions, it will be very easy for you to finish it off. I'll show you how. Let's read the question. The question says, Mr. Raj, aged 38 years, an Indian citizen. What are you able to conclude at this stage, guys? Mr. Raj, you are not a senior citizen, okay? So he's an Indian citizen, alright. He's carrying on manufacturing business. Now, as soon as you see manufacturing, what comes to your mind? In your intermediate syllabus for manufacturing assessees, there is only one special point, and that is additional depreciation, guys. So additional depreciation will come to your mind. So he's an Indian citizen. He is carrying on manufacturing business in Canada. So where will the source of his business income be? Outside India, Canada. He frequently visits India for business purpose on a regular basis. He was in India for the first time in 21-22 for 190 days, 22-23 for 145 days, and 23-24 for 155 days. Guys, it's very obvious what is this information. Last 4 years, stay, guys. So last 4 years, if you see, he has been in India for how many days? Last 4 years, 4 preceding previous years, he has been in India for 190 plus 145 plus 155, 490 days he has been in India in the 4 preceding previous years. Then the question says he decided to close his business in Canada and shift permanently in India. So he came to India on 1st November 24. Now tell me, when he comes to India on 1st November 24, can I say he has visited India? No, guys, he is not visiting India. I can't say that he has visited India because he is shifting permanently in India, which means he is not visiting India. He has come to India because he is going to settle down in India. So this is not a visit. On 1st November, I cannot say he is visiting India because the word visit indicates what? Visit indicates it's temporary. He's going to come and then he's going to go back. Visit does not mean he's going to stay here forever. So here he's coming to India to settle down in India. So this is not visit, guys. So he came to India on 1st November 24 and he started a business in Mumbai. So he already has a business in Canada, and now he's starting a business in Mumbai also. So his profit from business in Canada is 15 lakhs. So 15 lakhs, this is from his Canada business outside India. Source will be outside India, and this 5 lakhs is from his Mumbai business in India. Okay. Then the question, guys, with this much information, I can find his residential status, guys. Yes, they've given us his stay in India and all, everything they've given to us. So come on, tell me, how do we do the residential status? We always try which provision first? We always try the special provision first, but you can apply special provision only if some conditions are fulfilled. Condition number 1, assessee should be an Indian. Those of you who are wondering what is special provision, you have 2 basic conditions. No, one is 182 days previous year and 60 days, 365 days. You have one more condition, you have one more provision where you have previous year 182 days, then second basic condition previous year 120 days, and 4 preceding previous years 365 days, right? That 120 days, that provision I call as a special provision. So if you want to apply that provision, you have to fulfill some conditions. Condition number 1, assessee should be an Indian citizen or a person of Indian origin. Is this condition fulfilled? Yes guys, my assessee is an Indian citizen. Then condition number 2, assessee must be visiting India in the previous year. Did your assessee visit India? No, he is not visiting. Instead, he is coming to India forever. He is not visiting India in the previous year. So therefore, what can I conclude, guys? That condition 2 is not fulfilled. Special provision will not apply. So welcome to regular provision. Okay, now what does regular provision say? Regular provision says basic condition 1, in the previous year, assessee must have stayed in India for at least 182 days. Now how many days has my assessee stayed in India in the previous year, guys? He came to India on 1st November 24. So November, December, Jan, Feb, March. Totally in the previous year, he has stayed in India for how many days, guys? Only 151 days. So is your basic condition 1 fulfilled? Is previous year 182 days condition fulfilled? No. In the previous year, he has stayed in India for only 151 days. Then tell me what's your basic condition 2? But wait. Regular provision, basic condition 2, does something come to your mind? Pause, check. Think, tell me, is your assessee an Indian citizen who left India in the previous year as a crew member of an Indian ship? No. Is your assessee an Indian citizen who left India in the previous year for employment outside India? No. Is your assessee an Indian citizen or a person of Indian origin who is visiting India? Is he visiting India? No, he is not visiting India. I've already concluded that for you over here. So therefore, basic condition 2 I can apply, guys. Basic condition 2 says in the previous year, he must have stayed in India for at least 60 days. Is this condition fulfilled? Yes, he is in India for 151 days. And the basic condition 2, one more point is there. 4 preceding previous years put together, he must have stayed in India for at least 365 days. And yes, 4 preceding previous years, he has stayed in India for 490 days, guys. So even this condition is fulfilled. So therefore, your basic condition 2 is fulfilled. So therefore, what can you conclude now? You can conclude that your assessee is resident. Okay. Now ROR or RNOR, we have to check that. How do we check? How many additional conditions we have? 2 additional conditions we have. Additional condition number 1 says in 7 preceding previous years put together, assessee must have stayed in India for at least 730 days. But guys, notice in this question, the question says he came to India for the first time in 21-22 only. So 7 preceding previous years, he has stayed in India for how many days, guys? Only 490 days only. So is 730 days criteria fulfilled? No. So even one additional condition is not fulfilled. What will you conclude? You will conclude assessee is RNOR. Crystal clear. Very simple discussion. Nothing out of the world, nothing new. Residential status was pretty fine over here. So what is my conclusion now? Assessee's residential status, he is RNOR. Okay, now let's continue reading, guys. He has a business outside India. He has a business in India. That much information only till here. Okay, then the question says he does not own any house property in Mumbai. He is staying in a rented accommodation from 1st November on a monthly rent of 20,000. Guys, he's paying house rent. I've told you multiple times, whenever assessee pays house rent, immediately one section should come to your mind. Assessee is paying house rent, immediately I should think about section 80GG. But never make the blunder of directly applying section 80GG. No, always check your conditions. There are 3 simple conditions, guys. Condition number 1 is that the assessee must either be a self-employed person, okay, or if assessee happens to be an employee, then he must not be receiving HRA. Over here, your assessee is a self-employed person, guys. He's carrying on his own business and all. So condition 1 is fulfilled. Then your condition number 2 is, listen carefully, neither the assessee nor his spouse nor his minor child nor his HUF, none of them should own a house property in the same city in which he lives. Where is he living? In Mumbai. So in Mumbai, neither he himself, nor his spouse, nor his minor child, nor his HUF, none of them should own a house. Guys, is this condition fulfilled? We don't know. There is so much story still left. We don't know whether he is owning a house or not. We don't know. I'll keep this pending for now. Okay, and then what's your third condition? The third condition is that if at all the assessee owns a house property in some other city, that house property should not be what? That house property should not be self-occupied property. It can be let out, but it should not be self-occupied property. So these two conditions, we don't know guys whether fulfilled, whether not fulfilled, we don't know right now. So we'll keep this pending. Only after we read more points in the story only we will be able to come to this. Okay, so but anyways, remember he's paying rent how much? He's paying 20,000 rent. He's paying from 1st November. So rent he's paying for how many months? November, December, Jan, Feb, March. He's paying rent for 5 months only. Okay, keep that in mind. Then come forward. He made a donation of 50,000 to PM Cares Fund. Guys, PM Cares Fund will go to which section? Section ATG. In ATG, full 100%, guys. PM Cares Fund, I will get full 100%. And what about this donation, 20,000 to Prime Minister Drought Relief Fund? Drought Relief Fund also ATG, but under ATG, Prime Minister Drought Relief Fund is only 50% deduction. So 50% of 20,000 will be 10,000. So what's your total ATG now? ATG is 60,000. Now see, in this question they haven't mentioned, okay? No, they have mentioned check. Is check okay for you? Yes, because section ATG says if you're making payment of more than 2,000, you have to make the payment in non-cash mode. Even check is non-cash mode, so even that is fine for us. So ATG is 60,000. Okay. Then the most interesting adjustment of this question is this part, guys, which I'm going to bring to your classroom notes, and we will discuss this over here. Okay. Listen carefully. The question says he had purchased 10,000 9% debentures of ABC Private Limited. So what kind of debentures are these, guys? ABC Private Limited. It's a private company. So definitely these debentures are going to be unlisted debentures. Okay. So he purchased 10,000 9% unlisted debentures in August 2020. So what is August 2020? Date of acquisition. He purchased at 150 rupees each. So this becomes your cost of acquisition. Face value of each debenture is 100 rupees. Okay. He sold 2,500 debentures in April 2024. So this is his date of transfer. Totally how many debentures he had? 10,000, out of which only 2,500 he sold at 175 rupees each, and the remaining 7,500 debentures he sold in August 2024 at 155 rupees each. Guys, story is clear. Total 10,000 debentures he has. Okay, first he sold off 2,500, then he sold off the balance 7,500. So can I say end of the day he sold everything? He has sold everything. Okay, then listen, after this what happened? Interest on debentures is due on 30th June and 31st December every year. This part I'm keeping it pending for now, guys. This part I'll handle a little later for you. Let me finish off the capital gains part. Okay, now how do we start our capital gains discussion? We always start with capital asset transferred. So tell me, what are we transferring? Can I write 10,000 debentures? No, there are two different periods of holding. No, see, 2,500 debentures are sold separately, 7,500 debentures are sold separately. So I will treat as if there are how many assets? I will treat as if they are two separate assets. You can't say it is one single asset because different periods of holding. No, 2,500 debentures is sold at one point of time, 7,500 debentures is sold at another point of time. So I will treat as if there are two separate assets. So whenever I have multiple assets, I combine my first two steps, which is capital asset transferred and period of holding. Okay, now what is a capital asset transferred over here? What are we transferring, guys? Two assets. Number one, we are transferring 2,500 unlisted debentures. 2,500 unlisted debentures. Tell me, what's a period of holding? When did you buy these debentures? You bought the debentures in August 2020. When did you sell away these debentures? In April 2024. We always pause at the date of transfer, and what do we check? Is it before amendment or is it after amendment, guys? April 2024 is definitely before 23rd July 24. So before 23rd July 24, tell me, in section 50AA, you will have how many assets? You will have only two assets, guys. Before old provision, only two assets. Which two assets? You will have market linked debentures and units of debt oriented mutual fund. Is it market linked debentures here? No. Is it units of debt oriented mutual fund here? No. So 50AA will not apply. Okay, then tell me how many periods of holding you will have before amendment. 3 periods of holding you will have, 12, 24 and 36. This is unlisted debentures. So what will be a relevant period of holding? Relevant period of holding will be 36 months, guys. Then tell me, will I get indexation benefit? Old provision before amendment and all, I get indexation. And if at all they ask us for tax computation, how many tax rates will we have before amendment? Before amendment we have 10%, we have 15%, we have 20%, 3 tax rates we have. 10% is for 112A, 15% is for 111A and 20% is for 112. Okay, now here tell me, we've already identified the period of holding 36 months. Is this period more than 36 months, guys? Yes, this is more than 36 months. Clearly, this is more than 36 months. So therefore, what kind of an asset is it? Therefore, it is going to be a long-term capital asset. Okay. Now, after long-term capital asset, is it 112A? I always tell you, first try 112A. Will 112A apply over here? No, that's only for listed equity shares, listed units of equity-oriented mutual fund and all. 112A will not apply. 112 only will apply. Okay, so those of you who are attending my session for the very first time know that I always write these 4 things in the margin because of the amendment. Capital gains, you have amendments, no? So because of the amendment, only these 4 things you majorly have to remember while doing the computation. Okay, so these 4 things I generally put in the margin. This gives us some guidance for solving the question itself. Okay, so 112 will apply. Okay, then what's your next asset, guys? Next asset is 7,500 unlisted debentures. They were purchased in August 2020, but when did we sell them? We sold them in August 2024. Pause, check, think. Tell me, is this period before amendment or after amendment? This is on or after 23rd July 2024, guys. On or after 23rd July 2024. So after amendment. Now tell me, again in the margin, how many things I will write? Same 4 things I will write. But this time in section 50AA, how many assets I will have? I will have 4 assets. After amendment, we have 4 assets. What are the 4 assets? Number 1, market-linked debentures. Number 2, units of debt-oriented mutual fund. Number 3, unlisted debentures. And number 4, unlisted bonds. Do we have any of these 4 assets? Yes, so section 50AA will apply. So what if section 50AA applies? What will be the implication? If 50AA applies, I don't care about the period of holding, guys. It will straight away be what? It will straight away be a short-term capital asset. It will straight away be normal rate short-term capital asset. I don't care about the period of holding. Are you listening to me, everybody? If that is the whole magic of section 50AA, if 50AA applies, I don't care about the period of holding. It will straight away become short-term capital asset. Okay, guys, then period of holding, do I even care about period of holding? No, guys, it is straight away short-term capital asset. Then will I get indexation benefit? Will I get indexation benefit after amendment? No indexation benefit. And if at all they ask us to do tax computation, how many tax rates will we have after amendment? Only 2 tax rates we have, guys. One is 12.5% and the other is 20%. 12.5% will apply for your long-term 112 also, 112A also, and 20% will apply for your short-term, which is 111A. Okay, everybody. So with this, your basic point, your basic discussion is over. We always start like this so that we can get one, base for our capital gains answer. Once we've done this writing, we've actually understood the adjustment and now we are ready for the computation. So come on, everybody, tell me what's your first step in computation. We will start with full value consideration. Now, I've always told you there are only 2 adjustments which you have to remember in full value consideration. Which 2 adjustments? 50C and 50CA. Here, neither of the 2 will apply, guys, because it is not land building. Also, it is not unlisted shares. So, no 50C, no 50CA. I'll take the full value consideration as it is. See, I'll have to draw how many columns over here? I will draw 2 columns over here. One column will be for 2,500 debentures. And the other column will be for 7,500 debentures. Okay, now come on, have a look at the question. What's a full value consideration? You sold 2,500 debentures at 175 per debenture, so 437,500. Then 7,500 debentures we sold at 155 per debenture. which will be 11,62,500. We read the whole question, we did not have any expense on transfer, so this itself becomes our net consideration also. Now from this comes cost of acquisition. Cost of acquisition, I always make you think about how many things? Two things. Thing number one, will grandfather clause apply over here? No grandfather clause because it is not 112A. Then I ask you, will indexation benefit apply? What will you say? See, the first category, 2,500 debentures, you have mentioned indexation is possible. Okay, but is it long-term capital asset? Yes. Is it 112A? No. Is it slump sale? No. Is it depreciable asset? No. Is it bonds or debentures? Yes, it is bonds or debentures, therefore no indexation. Do you agree with me, everybody? Even though, listen guys, even though this period, even though it is before the amendment, and before the amendment, yes, indexation was existing. Before the amendment, yes, indexation was existing, but for short-term capital assets, no indexation. Slump sale, no indexation. Bonds and debentures, no indexation. 112A cases, no indexation. Bonds and debentures, no indexation. So even though this is before amendment, still no indexation at all. So I'll subtract the cost of acquisition as it is, guys. What is the cost of acquisition? 150 rupees per share. So 2,500 into 150, 3,75,000. Okay, this is for 2,500 debentures. What about 7,500 debentures? This is transferred after amendment, and after amendment here, which section are we applying? We are applying section 50AA, guys, and 50AA, I told you, we will not care about period of holding. It will straight away be short term, and if short term, will you have indexation? If short term, you will anyways not have any indexation, guys. You understood? These 7,500 unlisted debentures, this is the most interesting part because here section 50AA is being applied. You understood the implication of 50AA? Everybody? Yes, come on, give me one quick response. Did you understand section 50AA? Because the transfer is after amendment, 50AA will apply to unlisted bonds and debentures also. If 50AA will apply, what will happen? I will not care about the period of holding. I will straight away call it short term. So if it is short term, no indexation, guys. Okay, so that is it with your number over here. No cost of improvement also. So what's your net number? Here your net number will be 62,500. The 62,500 is long-term capital gain, guys. We've already identified over here. First category is long-term capital gain under section 112. Then your second asset will result in, guys, cost of acquisition I forgot to write over here. 1 second. What's your cost of acquisition? 150 rupees each. So 7,500 debentures into 150 per debenture, you will get 11,25,000. So when I subtract, I will get capital gains of 37,500, and this 37,500 I've concluded for you is short term, normal rate short term. So short term capital gains, normal rate is 37,500. All clear? Yes. So with this, our capital gains adjustment is over. We have 112 LTCG also. We have normal rate STCG also. Now what are we left with? Interest on debentures. Let's handle this. This is also interesting. Okay. See, I'll tell you. Tell me, when did we sell off the debentures first? April 24 we sold off. How many we sold? 2,500 debentures we sold. Okay. So when are we going to get the debenture interest? 30th June and 31st December we are going to get. Every 6 months we are going to get. Are you noticing? The gap is every 6 months. So therefore I am going to get half year's interest, half year's interest. So on 30th June, how many debentures do I own? I earlier had 10,000. I sold off 2,500 in April 24. So on 30th June 2024, I am owning only 7,500 debentures. Okay, what's the face value per debenture? Face value per debenture is 100 rupees. And what is the interest rate? 9% debentures, guys, into 6 by 12. Why 6 by 12? Because every 6 months we are getting interest. No, biannual interest. 2 times I'm getting interest. 6 months each time. So how much interest will I get? 7,500 into 100 into 9% into 6 by 12. How much will this be? You will get 33,750. Okay. Then on 31st December, tell me how many debentures do I own on 31st December 2024? None, guys. I don't own any debentures because I sold everything by August 24. The balance debentures I sold in August 24. So on 31st December 24, I don't have any debentures left with me. So what is the total debenture interest now? 33,750 plus 0, 33,750 will become your total debenture interest. Okay guys, the question says he wants to opt out of the default regime, which means our whole computation will be as per the normal provisions, as per the regular provisions, normal provisions. Okay, now with all this information, can we come to the MCQs, guys? We've done all our analysis. We've concluded he is RNOR. Guys, ATGG, we can think about ATGG now. Tell me, we read the whole question. Does he own a house in any other city? No guys, he doesn't own a house in any other city. So even this condition is fulfilled. If at all he owns a house in any other city, it should not be self-occupied property. He does not even own another house. So all my conditions are fulfilled. Therefore, section ATGG will apply. Now under ATGG, tell me, how do you calculate ATGG? How many things do you calculate totally? Totally 3 things, guys. First is 5,000 per month. Here 5,000 into how many months? Only November onwards only we are paying rent, no? So 5,000 into 5 months only, which will be 25,000. Then what is the second thing you calculate? Second is rent paid minus 10% of your adjusted total income. And the third thing is 25% of adjusted total income. So which number do we need now? We need adjusted total income, alright? For adjusted total income, first of all, we need the GTI. So let's do all our income computation. Easily we can do, guys, because we're done with all our adjustments over here. So easily we can compute the GTI of our assessee. Tell me, what are all the income numbers he has? First para was only about stay in India. Second para, 2 businesses he's having. Canada business will I consider? Canada business will I consider? No guys, source outside India, received outside India. He's an RNOR. I will not consider. Mumbai business will I consider? Yes. So he is having PGBP of 5 lakh rupees. Then what else? ATG he is having 60,000 rupees. Capital gains we've already calculated, guys. 112 LTCG also he is having. Normal rate STCG also he is having. What is 112 LTCG? 62,500. Normal rate STCG is how much? 37,500. In addition to all this, remember he had interest also, which we calculated and we've kept everything ready. How much is the interest? 33,750. So if I add up, guys, what is his GTI? No other income. His GTI will be 6,33,750. This is his GTI. Now from this, what are the chapter 6A we have? In this question, we have ATG how much? ATG is 60,000. Any other chapter 6A, guys? Apart from this, we will have ATGG only. ATGG is something which I'm anyways going to compute now for you. So to compute ATGG, I need adjusted total income. Now everybody listen to me carefully, okay? There are 2 ways in which adjusted total income can be computed for ATGG. Listen, I'm not talking about ATG right now. In ATG also you have to compute adjusted total income for category C, category D. I'm not talking about that, okay? I'm talking about adjusted total income for section ATGG. There are 2 ways of computing it. In one method, I can straight away take this GTI, I can subtract chapter 6A. That is one way of computing. There is one more way of computing which is generally followed practically as well, and that is what I'm going to do for you over here. That second method is where I'll take the GTI, I'll add back section 111A STCG, I'll add back all LTCG, I'll add back all chapter 6A other than ATGG. Guys, the reason why I follow this method is because this is very similar to what you do in section ATG. Even in ATG, you have to calculate adjusted total income, and there this is how you calculate adjusted total income, guys. So in ATGG also, I follow the same approach. But however, please know that there is one more method of computing adjusted total income for ATGG where I just take the GTI and subtract chapter 6A as it is. That is also an eligible method, but I generally don't follow that method. I follow this method so that ATG and ATGG gives us the same learning point, and both the methods are accepted by ICI. So it doesn't matter which method you choose. You can follow whatever your respective faculty has taught you. I'm just telling you over here that there are two views and both the views are perfectly alright. Okay, I follow this view so that we have lesser to remember. Otherwise, we have to remember separately for ATG, separately for ATGG. Okay, but when both the views are correct, I will remember in such a way that lesser burden on my memory. Okay, and one more thing, did you notice? Am I subtracting all special rate income? Am I subtracting all special rate income over here, guys? No, I'm not subtracting all special rate income. Which special rate income I'm not subtracting here? Lottery income. I'm not subtracting lottery income over here. Did you notice? I'm not subtracting my casual incomes. Only two incomes I'm subtracting. Only two special rate incomes I'm subtracting. 111A STCG and LTCG. If you subtract casual income, no, that will become wrong. You're not supposed to subtract casual income. Income Tax Act is very clear about it. Whether you read the BEAR Act, whether you read ICI study material, it's very clear you should not be subtracting casual income over here. Okay, so what's your GTI number? Take the numbers, guys. We've done the calculation. GTI is 633,750. Do we have 111A STCG? No, the STCG we calculated is normal rate STCG. Do we have 111A STCG? No, we don't have. Do we have LTCG? Yes, LTCG we have 62,500. LTCG we have. Do we have chapter 6A? Yes, guys, ATG we have 60,000. That's it. So what is your adjusted total income for the purpose of ATGG? You will get 5,11,250. Now you can easily calculate this. How much rent are we paying? 20,000, guys. So 20,000 into 5 minus 10% of adjusted total income. So 5,1125. How much will this be? 20,000 rent paid minus 10% of adjusted total income. You will get 48,875. And then 25% of adjusted total income will be how much? Calculate 5,11,250 into 25%. You will get 127,813. Now out of the three, which number do I have to pick? Out of the three, whichever is the least. Whichever is the least, this number is going to become your ATGG deduction. So we were calculating our total income over here. So my ATGG deduction is 25,000. So what is my assessee's total income, guys? Total income will become 548,750. Okay, now with all these numbers, can we finally go to our questions? Let's see what are they asking us. The first thing they're asking us, residential status. We've already done the residential status, guys. Assessees RNOR. Option A. Then what is the amount of capital gains? Capital gains also we've already computed. 112 LTCG is 62,500. Normal STCG is 37,500. Option D, guys. LTCG and STCG. Then GTI. GTI also we have computed already. How much is a GTI? 633,750. We've already computed this also. And then they're asking us what is a chapter 6A deduction. Chapter 6A also we have computed. Only two chapter 6A we are having here, ATG and ATGG. So total chapter 6A will be how much? 85,000, guys. 85,000, which is your option B. 85,000. So we have A, D, B, B, and one more question. Tax liability. Now this is something which we have not computed. Can we do the computation now? Tax liability computation we have to do, guys. Listen to me. What was the assessee's GTI? See, I'll do the computation for you over here. Okay, GTI is 633,750. Chapter 6A you can subtract against what? Only against normal rate income. So ideally we should split at this stage. Okay, so GTI 633,750. I will split my GTI into two parts. What is my normal rate GTI and special rate GTI? What are the special rate incomes I have over here? Only one special rate income I have over here, 112 LTCG, guys. So I'll put it separately. Okay, 112 LTCG, 62,500. And what is my other normal rate income now? balance normal rate income will be 571 250. Okay, whatever chapter 6A we want to subtract, we can subtract it only against normal rate income. So how much is your chapter 6A totally? 85,000. I can subtract only against normal rate income. So what is my balance normal rate income now? 486 250, and my special rate income is 62,500. So what is my total income? 548,750, which is already in multiples of 10. No need to do any rounding off. Okay. In addition to all this, they have in this question asked us to compute the tax liability. So how to compute tax? Whenever you compute tax, always start by thinking which regime are you following. You are following the normal regime, guys. And then tell me, what will the basic exemption limit be? Assessee is 38 years, we've already concluded he is not a senior citizen. So his basic exemption limit will be 2,50,000 rupees, guys. So how many columns will I draw to calculate his tax? 1 second. Yeah, look at this now. How many columns will I draw now to compute my tax? 2 columns, guys. 2 kinds of incomes I'm having. I'm having normal rate income also, 112 LTCG also. What's my normal rate income? 486 250. Special rate income 62,500. Now this basic exemption limit we should always adjust where first? Normal rate income, guys. So I'll adjust my basic exemption limit over here. Okay, so how will you compute tax now on normal rate income? Up to 2,50,000, no tax. Whatever is the excess above 2,50,000 up to 5,00,000, on that 5% tax. So 486 250 minus 2,50,000 into 5%. The usual slab rate calculation, guys. So 486 250 minus 250 into 5%, you will get 11813. Now be careful. 112, what is the tax rate? Come here, come to the classroom notes I've already done for you. 112, this was before the amendment. No, before the amendment, what is 112 tax rate? We've already done the thinking. No, not 12.5. 12.5 is after the amendment. This 112 LTCG that we have is before the amendment. And before the amendment, 112 tax rate is 20%, guys. So this will be taxed at the rate of 20%. So your total tax on 112 LTCG will be 12,500. So what's your total basic tax now? Total basic tax is 24,313. Will you have 87A rebate? No, because total income is more than 5 lakhs. No surcharge because total income is within 50 lakhs. So you will straight away add cess. After adding 4% cess, you will get 25,286, which you will round off to the nearest multiple of 10, 25,290. This will be the tax liability for you. Okay, 25,290. So come to your answer, tax liability 25,290, option A. Alright, so this was your first case study based MCQ. This was like the best question of your RTP, especially because section 50 AA was applied for you over here. In none of your ICI study material questions, if you see, section 50 AA applicability is there. In no other ICI question till now, any RTP, any MTP you take, 50 AA application is not there anywhere. This was the first time when ICI gave us a question with section 50 AA applicability, and that is why I wanted to do this question for you. Alright guys, so can we close this question? Yes, and did you notice why I told you to do all the thinking while reading the question itself? Did you notice somewhere or the other all the thinking was useful? This is the best part of your DT case study based MCQs, guys. Unlike law, unlike audit, unlike SM, unlike your other papers MCQs, when it comes to DT, when you're doing the MCQs, do all your thinking while reading the case study itself. That way, you don't have to keep coming back. And every information given in the story will be relevant somewhere or the other. Okay, so we'll close this question over here. Our learning over here was 50 AA and even 80 GG for some of you. Okay, now I'll close this question and I'll come to the next question now. Come to question number 6, guys. So in your RTP, there was only one case study based MCQ, the one that we just now worked out. Question number 6 onwards, you have descriptive questions. Let's take them up one by one now. This is a pure salaries question, but a lot of adjustments under salaries will get revised for you through this one question, guys. Let's read the question and then we will work it out over here. Answer to question number 6. Okay, listen to me carefully. Let's work this out. And one more thing, let me tell you, this PDF, you're seeing me doing a lot of writing over here. These classroom notes, you see me do a lot of writing over here. Both I will share in the Telegram channel after the class is over, okay, so that if you want to do any reference, you can do it later. Okay, come to question number 6 now. The question says, Mr. Kunal is aged 27 years. What can you conclude at this stage? Mr. Kunal, you are not a senior citizen. He is an employee in a private company. What can you conclude at this stage? Mr. Kunal, you are not a government employee or a non-government employee. He is posted in Delhi. Now, they have given us some 8 adjustments. You are required to compute income under the head salaries in the hands of Mr. Kunal for assessment year 25-26. Are they asking total income? No guys, only salaries they are asking us, assuming he wants to pay tax under the default tax regime, which means as per 115 BAC guys, we have to compute his salaries. Are you ready? Yes, I'm very excited about this question because so many adjustments in salaries will get revised for you through this one question. Come on. The question says he was appointed on 1st February 23 in the scale of 60,000, 1,000 to 70,000. So how will his salary be? Tell me. 1st February 23 to 31st Jan 24. What is his salary? 60,000. Then 1st February 24 to 31st Jan 25. His salary will be 61,000. Then 1st February 25 to 31st Jan 26, it will be 62,000. Okay. Listen now. Already able to see better? Fine. So this is a salary number. Now our year is 24-25. So till 31st Jan 25, it's going to be 61,000, and February onwards it's going to be 62,000. So let's come to our material over here and let's keep writing side by side. So first of all, we have basic salary. How much? 61,000 is till January. So how many months 61,000 guys? April to January, 10 months. And then 62,000 is for your last 2 months. That is Feb and March. So your total basic salary will be 7,34,000. Do we get this number? Simple, right? Till 31st Jan 61,000, first 10 months guys, and then last 2 months 62,000. Okay, then the question says he furnishes you the following information for the previous year 24-25. DA is 25% of basic salary, 60% is forming part. I don't care about the 60% right now because that I will consider only when I do HRA, RFA calculation and all. Total DA is how much? 25% of basic salary. So DA is 7,34,000 into 20%, which will be 146,800. Okay, this is also done. Then bonus equal to 1 month salary paid in November 24 on basic salary applicable for that month. November month, what will the basic salary be? Okay, I made a mistake. Sorry, 25%. 7,34,000 into 25%. Sorry. This should be 183,500. Okay. Then we have bonus. Bonus is paid in November 24 on salary applicable for that month. So November month, what is the salary? 61,000 guys. So that November month salary is paid as bonus. So bonus is 61,000. Then after this, the question says leave encashment. Tell me, has your employee retired during the year? Has your employee retired during the year? No guys, no. You are doing calculation for all 12 months. He has not retired during the year. So whatever leave salary he is getting, this leave salary is during service, and any leave salary you get during service, what's the tax treatment guys? It will be fully taxable. So leave salary how much? 10,000. So leave salary 10,000 fully taxable. Then comes your next adjustment, interesting adjustment. He received a motor car perquisite guys. He received it on 1st December 24. So how many months? December, Jan, Feb, March. Only for 4 months. Cubic capacity is more than 1600 cc. he received along with chauffeur. So driver is also provided for official and personal purposes, both purposes. Motor car is owned by employer, expenses are met by employer. Tell me guys, which bucket is this? This is your first bucket. Car is owned by employer. Car is owned by employer. Expenses are also incurred by employer. So in this case, what is the car used for? Car is used for official and personal purpose. Official and personal purpose. So inside your first bucket, it is the third point. And in the third point, how do you calculate? Tell me. It depends upon the cubic capacity of the car. Cubic capacity is more than 1600 cc guys. So 2400 per month will be taxed for 4 months. But driver is also provided. So you will add another 900 per month. So what will be your total taxable value now? 13,200 will be your taxable value of motor car perquisite. But there is a catch. This perquisite will be taxable only for specified employees guys. Is your employee a specified employee? Yes, his basic salary is clearly more than 50,000. So yes, he is a specified employee. So yes, I can aram say tax this perquisite for him. So what is a motor car perquisite? You understood the motor car perquisite guys? More than 1600 cc, no? So 2400 per month is taxed. But because driver is also provided, we will add another 900 per month. So totally 13,200. Simple adjustment guys. Then comes your next para. Now this is the one that if at all you find some challenge in this question, the challenge will be in this para, and that is why I'm going to bring it to your classroom notes and discuss it straight away with you over here. Okay, the question says his employer gave him a loan of 2 lakh rupees on 1st June 24, which is repayable in equal quarterly installments over 2 years. So totally how many installments will be there guys? Quarterly installments over 2 years. In 1 year there will be 4 quarters. So in 2 years there will be 8 quarters. So it will be paid in 8 equal installments. So what will be the amount per installment? 2 lakh rupees has to be paid in 8 installments. So 25,000 will be per installment guys. Simple. Okay, he is going to start paying when? Only from 1st October 24 he will start paying. So see, June to September, how much will be outstanding? Tell me. Full 2 lakhs will be outstanding. Okay, then October onwards he is going to start making repayment. Repayment will happen every quarter. So repayment will happen every 3 months. So October, November, December. Next repayment will happen in Jan, Feb, March. Okay, after this next repayment will happen in April. So every quarter he is going to repay. So first he will repay in October. The next quarter will be Jan. He will repay in Jan. After that he will repay in April only. So in our year only till March we will stop. Now tell me, October to December he will repay 25,000 in October guys. So October to December how much will be outstanding? 1,75,000 will be outstanding. January month again he will repay 25,000. So Jan onwards how much will be outstanding? 1,50,000 will be outstanding. Now how many months? June, July, August, September. This is for 4 months. October, November, December 3 months. Jan, Feb, March also 3 months. Now see, why are we taxing this? Read the question. SBI lending rate is 9.5% on 1st April 24. Employer recovers interest at 5.5%. What is SBI lending rate in the beginning of the year guys? See, are you noticing? Are we looking at the SBI lending rate on the date of the loan? No. Always SBI lending rate you take on 1st April. 1st April what is the SBI lending rate? 9.5%. How much is employer charging? Only 5.5%. So what is the benefit I'm getting? Don't you think 4% benefit I'm getting guys? So I'm getting a loan at concessional rate of interest. I'm getting a loan at lesser rate of interest. So this 4% is a concession. Okay, and do you remember learning that in this perquisite there are 2 exemptions also? First is the original loan, aggregate original loan within how much? Tell me, do you remember the amounts? Should be within how much? Should be within 20,000. Tell me, the aggregate original loan within 20,000 over here? No, it is more than 20,000. We have one more benefit. We have one more exemption. Is a loan relating to medical treatment. No, it is not relating to medical treatment also over here. So if the original loan amount is within 20,000, I won't even do calculation. I will straight away say it is exempt. Also, if the loan is for medical treatment of Rule 3A disease, I will simply say it is exempt. I won't even do calculation. But here, none of these two, guys, which means I will do calculation. Okay, so tell me, how much is the interest saved by your SSC? 4%, guys. 4% here, you're calculating for 4 months. Then here, 1,75,000 into 4% into 3 months. We've done the thinking over here. This is again 4% into 3 by 12. So how much will this be? Calculate, please. Check the numbers. Do you get this number? 5917. You understood? In October, I am repaying. Again, I am repaying in Jan. 25,000, 25,000, I will keep repaying. So, whatever is outstanding, on that outstanding amount, you will calculate the taxable value. So, 5917. So, interest, concession, 5917. Okay, then what else are we having in the question? Come on, guys, we're done with the 5th adjustment. Let's move forward. Come to the 6th adjustment now. 6th adjustment, the question says his employer gave him RFA, your favorite adjustment. Employer gave him RFA, fully furnished, guys. So it's a furnished RFA in Delhi from 1st April 23. 1st April 23 means what? Current year, last year? Last year. So since last year, since 23-24, he is enjoying one RFA. The house is owned by the employer. If it is owned by the employer, it fully depends on what? If it is owned by the employer, RFA, come on guys, if the RFA is owned by employer, it fully depends upon the population of the place. Now where is the house? House is in Delhi, guys. So definitely population is in the highest slab possible, more than 40 lakhs. So what will be the taxable value? Tell me. Taxable value will be 10% of salary. You remember, right? RFA owned by employer, it depends upon population. You have 10%, 7.5%, 5% depending upon the population. But because here the house is in Delhi, I'll assume highest possible population slab, 10% of salary will be taxable. Now tell me, for computing RFA, salary will have how many components? Salary will have 7 components, guys. You will have basic salary. You will have DA, which is forming part. You will take all commission. Then you will have bonus. You will have fees. You will have taxable allowances. And you will have other monetary payments. These are your 7 components of RFA. Anyways, let's read the whole question now. His employer gave him furnished house in Delhi. This house is owned by the employer. Perquisite value of furnished RFA during 23-24. Last year's information they have given to us. So 23-24, what was the taxable value of the RFA? 92,000. Okay. The accommodation is continued to be provided by the employer to the employee in 24-25 also. Okay. So last year we had the same RFA. Last year's taxable value was 92,000. Fine. Then the question says, furniture and appliances provided with the house were bought by the employer at an aggregate cost of 1,50,000 on 1st Jan 23. So tell me, current year should I do only for 3 months? No guys, in 22-23 it was bought. Okay, so current year I'll take the number as it is. Furniture and appliances, it's a furnished house. So value of furniture, how do you calculate? Value of furniture. To find taxable value of furnished RFA, how do you find the value of furniture? If the employer has taken the furniture on hire, you will take the hire charges paid by the furniture. If the employer owns the furniture, what will you do? If the employer owns the furniture, you will take 10% of the cost of the furniture. So 10% of 1,50,000 will be how much? 15,000 guys. This will be the taxable value of furniture. Okay, then electricity and water bills 5,000 per month were paid by the employer. This will become bills paid by employer. Facility guys, facility of electricity and water bills taxable only for Taxable only for specified employees. We've already concluded assessee is a specified employee. So how much will this be? 5,000 into 12. I can finish this off, guys. Electricity and water facility. The amount is 5,000 into 12, which is 60,000. This is done for me. Now we have to handle the RFA part. Come on everybody, for a moment, forget about last year's number. Let's do fresh calculation for the current year first. Okay, first of all, I need salary for RFA. Salary will have 7 components. What is our basic salary? Have a look at the question. 7,34,000. What about DA? DA forming part. 183,500 is total DA. Out of this, how much is DA forming part? Only 60% is forming part, guys. So 183,500 into 60% will be how much? 1,101,000. We read the whole question. Did we have any commission? No. We read the whole question. Did we have bonus? Yes, bonus was 61,000. We did not have any fees. We did not have any taxable allowances. Did we have any taxable monetary payments? Let us come and see over here. This is a facility. We don't consider perquisites. This is also a perquisite. We don't consider perquisites. Motor car is also a perquisite. We don't consider that. But leave salary, guys, this becomes taxable. It is taxable. It is monetary payment, money. Employer has given money. So even this I will include in my RFA salary computation, my leave salary received during service. So what will be our total salary for the purpose of RFA? You will get 9,15,100. Okay, so I'll give you one small tip. Okay, when you're calculating this RFA salary, no, tell me, will you include advance salary? No. Will you include arrears of salary? No. Will you include employer's contribution to RPF? No. Will you consider perquisites? No. Will you consider retirement benefits like leave salary received at the time of retirement? Retirement benefits also you will not consider. No, guys. See, if leave salary is received during service, if gratuity is received during service, that you will include, okay? But otherwise, if you're receiving benefits at the time of retirement, you will not include, okay? So what's your salary for the purpose of RFA? 9,15,100. Okay, now tell me, how will you calculate the value of RFA? I already told you over here, 10% of salary. So 10% of salary will be how much? 91,510. So this will be the taxable value of unfurnished RFA. But we have what kind of RFA, guys? Furnished RFA. So to this we will add the taxable value of furniture. And for furniture, how much will we add? We already did the thinking. 10% of the furniture, which is 15,000. So for us, what is the taxable value of the furnished RFA? The furnished RFA taxable value is 106,510, guys. 106,510. Till here everybody is clear. Can I take you to the next part now? Now listen. They have the most interesting part of this question. See, till here everything was easy. One interesting adjustment over here was, of course, the loan at concessional rate of interest. The second interesting part of this question is the fact that they have given us a perquisite value of the last year. What is the last year's perquisite value? 92,000. Now the law says that your RFA value should not exceed last year's taxable RFA value indexed after indexation. The thing is, if the same house, if you continue to get the same house for multiple years, then you will see what is the last year's RFA, index it, it should not increase, it should not exceed that. What is last year's RFA? 92,000. Index it. How to index it? CII of the current year is 2425. 2425 index is 363 divided by CII of last year. 92,000 is 2324's RFA, right? 2324's CII is 348. So how much is your indexed value of RFA? Indexed value of RFA will be 95966. Okay, so what will be your taxable value of RFA for the current year now? Whatever you have calculated, or this indexed number 95966, whichever is lesser. So which is a lesser number over here? 95,966. This will become your taxable value of RFA. Are you understanding? This is the most important adjustment of this question, and that is why I'll repeat it once again for you. Listen to me carefully. See, the question says over here that, assessee is getting a furnished RFA. So first I found the value or the taxable value of the furnished RFA. This was a taxable value. Then after this, we checked last year's RFA value. This was last year's RFA number. We are supposed to index that. See, if they don't even give us this number, we won't apply all this drama. We'll straight away conclude with this. But because they have given to us 2324's RFA number, we will do indexation. Okay guys, so 2324's RFA number is 92,000. We will do indexation. So this is your indexed value of last year's RFA. So current year, whatever you have calculated, this or the last year's RFA value after indexation, whichever is lesser, this is going to be your taxable RFA for the current year. Did everybody understand? And one more thing, did you notice? Am I comparing the unfurnished number? No. After doing all RFA adjustments, I am finding the final RFA number. The final RFA number, that is what I am comparing with the indexed RFA of the last year. So out of the two, whichever is lesser will be your taxable value. So 95966 RFA 95966, this will become your taxable value. So this was your unfurnished RFA. This you understood, your salary into 10%. It was a furnished RFA. So we took the value of furniture. Furniture is 1,50,000. If the furniture is owned by the employer, we take 10% of the cost of the furniture. So 10% of 1,50,000 is 15,000. So this is how we got our total taxable RFA value. This number I will compare with the indexed value of last year. So out of these two, whichever is lesser is what will be your taxable RFA value. Okay, and one more last adjustment we have over here, guys. His colleagues gifted him a mobile phone worth 45,000 from their own contribution on account of his marriage. What about this? Two things. Thing number one, this will go to IFOS, because did your employer give this? No, it is your colleagues who gave it to you. It is not your employer who gave it to you. So first of all, it will not come under the salaries head. And point number two, under IFOS, you can tax it under movable asset, but you can tax it under movable asset only if it is first of all a capital asset, guys. A mobile phone is movable and it is used for personal purposes. It is not a capital asset, it is a personal effect. So because it is a personal effect, no IFOS also. Third reason, it is worth only 45,000, which means its value is within 50,000. So therefore, again, no IFOS. Third reason, it is on the account of his marriage. Any gift on the occasion of marriage is fully exempt, hence no IFOS. Understanding? So first of all, no salaries, and secondly, no IFOS also. And why no IFOS? Because of three reasons. Reason number one, it is not a capital asset, it is personal effect. Reason number two, its value is less than 50,000. Reason number three, it's on the occasion of his marriage. Okay guys, that's it. Come on, add up and tell me what is his gross salary at this stage. Gross salary, please. You will get 1163,583. And what should I remember to subtract at this stage? Standard deduction, guys. Don't forget my assessee is following 115 BSc. So how much standard deduction you will get? 75,000. In 115 BSc, no professional tax, no entertainment allowance. Only one deduction you will get, which is standard deduction. So your net taxable salary will be 10,88,583. Should I round this off? No. We round off only total income and tax. We don't round off each head of income. So this will become your taxable salary. That's all, everybody. Easy, right? Two interesting adjustments over here. One, of course, was the interest adjustment, and second was this RFA adjustment. Alright, can I close this? Can I take you forward, please? Can I go to the seventh question? Seventh question is a nice capital gains question, guys. You remember, right? You must have learned the this part. In capital gains, you must have learned that amendment no, 20% with indexation, 12.5% without indexation. That will get covered for you through question number 7. Okay, so let's take this up now. Let's read the question and then we will work it out nicely. Come on. The question says, Miss Priya has always been financially aware and strategic with her investments. Okay. In Jan 2022, she saw an opportunity in gold and she purchased gold jewelry. So when did she purchase? Jan 2022, this becomes her date of acquisition. She purchased it for 3,25,000. This becomes her cost of acquisition, believing it would be a safe investment for the future. Okay. In October 24, gold prices increased and she decided to sell her jewels. She sold when? On 31st October 24. This becomes a date of transfer. She sold for 4,75,000. This becomes a full value consideration. Till here, pretty straightforward. Then the question says she also sold her house property. So how many capital assets has she sold, guys? 2. She has sold gold jewels here, and here she is selling her house property in Delhi. When did she sell this one? On 1st December 24. This becomes a date of transfer. She sold for 80 lakhs. This becomes a full value consideration. Stamp duty value on the date of transfer was 90 lakhs. This is the STV number. Why have they given us STV? Of course, for the purpose of section 50C. Then the question says she purchased this property on 15th July 1998. This becomes her date of acquisition. Guys, looking at this date, does something come to your mind? She purchased the property on 15th July 1998. She has clearly purchased the property before 1st April 2001, guys. Now, whenever you purchase a property or any capital asset other than intangible, any other capital asset, if you purchase before 1st April 2001, which number will I change? Cost of acquisition number I will change. Your cost of acquisition number will now be actual cost of acquisition or FMV on 1st April 2001, STV on 1st April 2001. Correctly tell me, out of these two numbers, whichever is lesser. Then out of these two numbers, whichever is higher. That's how we will calculate. So come on, she purchased the property for 8,80,000. So this is her actual cost of acquisition. FMV on 1st April 2001 was 10,80,000. Okay. And STV on 1st April 2001 was 10 lakhs. Fine. And then incurred brokerage. Guys, she incurred brokerage and other expenses 1% on purchase price at that time. Is this expense on transfer? No, she has incurred this at the time of purchase, guys. So what will you do with this 1%? You will add it to her actual cost. So her actual cost will actually be what? Her actual cost will actually be 8,80,000 plus 10%, which will be 9,68,000. This is her actual cost of acquisition number. Okay, now come on, let's begin the game. Tell me, out of these two numbers, which number I should pick? The lesser number, which is 10 lakhs. Now 9,68,000 or 10 lakh, which number I should pick? Whichever is the higher number. So 10 lakhs. So therefore now tell me, what is my revised cost of acquisition? Guys, 1 minute. There was one small silly mistake over here. This is 1%. So 8,80,000 plus 1% will be 8,88,800. The expense, the stamp duty, which she has incurred at the time of purchase, I will add to her actual cost of acquisition. So this will be her actual cost of acquisition. Won't make much of a difference. Answer will anyways be the same. Out of these two, whichever is lesser, which is this one, this or this, whichever is higher, which is 10 lakhs. So what's your revised cost of acquisition now? 10 lakhs. Okay. Then the question says, compute capital gains tax. We have to compute tax to be paid by Ms. Priya for 25-26, assuming her other income exceeds BEL. So, assuming that there is no BEL left, we have to compute tax. Are you ready, guys? You will enjoy this question. Can we begin with this solution? Yes, come on, let's do this. Sit up straight and give me answers as perfect as you can. How many assets do I have in this question? I have 2 assets, guys, jewels and house property. Two assets I have. So when I have multiple assets, I combine my first 2 steps. What are my first 2 steps? Capital asset transferred and period of holding. Okay, what's the first asset we are transferring? First of all, we are transferring gold jewels. Tell me, when did we acquire the gold jewels? We've already done all the thinking. See, date of acquisition. Jan 2022. When did we transfer? 31st October 2024. What do we do at this stage? We pause, check, think. Is this period before amendment or after amendment? It is on or after 23rd July 24. So how many things will I think about? 4 things I will think about always. First of all, in section 50AA, after amendment, how many assets I will have? 4 assets I will have. Tell me, is it market linked debentures? No. Is it units of debt oriented mutual fund? No. Is it unlisted bonds? No. Is it unlisted debentures? No. So none of the 4 assets. So 50AA will not trouble me in this question. Okay guys, then after amendment, how many indexation how many periods of holding will I have? Only 2 periods of holding I will have, 12 and 24. This is jewels guys. So what will be the period of holding? 24 months. Then after amendment, will you let me do indexation and all? No. And after indexation, if I have to compute tax, only 2 tax rates you will put on me. One is 12.5% and the other is 20% guys. 12.5% will apply for your long term, that is 112 also, 112A also. 20% will apply for your short term, which is 111A. Okay, now tell me everybody, this period is definitely more than how many months? More than 24 months we've already identified. So therefore this is going to be long-term capital asset. Which section guys? It can't be 112A because it is not listed equity shares and all. It has to be section 112. Okay, then after this we are selling one more asset. We are selling her house property in Delhi. Tell me about house property now. When did she buy the house? Date of acquisition is 15th July 1998. What is the date of transfer? Date of transfer is 1st December 2024. Now this period is again stop. This date again, what will you check? It is on or after 23rd July 24. So again same 4 points will apply over here guys. The same 4 points will apply. 50AA will not apply. Period of holding 2 you will have 12 and 24. For house property, what will be the relevant period of holding? 24 months and no indexation and 2 tax rates. Okay, so this period is also more than 24 months. So this is also a long-term capital asset, 112 long-term capital asset. Okay, now we will start off with our computation. So what's your first step in computation? Full value consideration. I'll draw 2 columns. One column will be for jewels, other column for house property. For jewels, what's the full value consideration? 4,75,000. For house property, what's the full value consideration? Here we have to apply 50C. Can I talk to you about 50C please? See, we never blindly apply 50C, okay? We always check conditions first. Condition number 1, the capital asset should be land, building, both. Yes, it is a house property. Condition 1 is fulfilled. Condition 2 is that STV should be more than 110% of FVC. Look at the question carefully. What is the STV number? 90 lakhs. What is 110% of FVC? See, FVC is 80 lakhs. 110% will be 88 lakhs. Is 90 lakhs more than 88 lakhs? Yes guys. So both your conditions are fulfilled. 50C will apply. Now what does 50C say? 50C says whatever is your real full value consideration, ignore that. Take the STV. Here STV is 90 lakhs. This STV of 90 lakhs will become your deemed full value consideration. So I will ignore the actual full value consideration of 80 lakhs. The STV number will be deemed to be my FVC. So which number I should write over here? 90 lakhs. We read the whole question. We did not have any expense on transfer. So this itself becomes net consideration. Then less cost of acquisition. How many things do I make you think about over here? 2 things. First of all, will grandfather clause apply? Is it section 112A guys? No, it is 112. Then I ask you, will I do indexation? I have concluded that the transfer has happened after amendment. So no indexation guys, no indexation. I'll take the cost as it is. For jewels, what is the cost of acquisition? 3,25,000. We'll subtract it as it is. For house property, we've done all the thinking. What is the cost we are taking for house property? 10 lakhs. Okay, so that's it guys. No cost of improvement also. So what will your capital gains number be? Both are LTCG, 112 LTCG. Your capital gains number will be 1,50,000 for jewels and 80 lakhs for house property. Till here, all clear? Yes, can I take you forward, please? This was my computation, guys. In the computation part, I've not done any indexation. Why no indexation? Because the transfers happened after amendment, and after amendment there is anyways no indexation option. Okay, now they have also asked us for tax computation, which is the most interesting part of this question. The question says that other income is more than basic exemption limit. So how much BEL are we left with? We don't have any BEL that we are left with. No basic exemption limit at all over here. So straight away I'm going to start the tax computation. Now be careful. Tell me, for jewels, how will you compute tax? At what rate? For jewels, 112, no. 112, what's the tax rate, guys? 12.5%. So for jewels, straight away I'll apply, I've already told you over here, 20% is for 111A. 12.5% is for 112 and 112A. So 112 it is, this is going to be how much? 18,750. Okay. Now comes house property. House property, how to compute? Listen to me. First of all, what is your general tax rate? Same 112, no. 112, what's your tax rate generally? Same 12.5%, guys, generally. 112 will be 12.5%. So this is going to be how much? 80 lakh into 12.5%, you will get. 1 second. 80 lakh into 12.5%, you will get 10 lakhs. This is general. But however, you have an option. When do you apply the option? You can apply the option only if 4 conditions are fulfilled. What are the 4 conditions? Condition 1. Assessee should be a resident individual or HUF. Fulfilled or not fulfilled? Fulfilled. Assessee is an individual, guys, Miss Priya. I'll assume she is a resident. So condition 1 fulfilled. Condition number 2. What should the capital asset be? Land, building, both. Yes, guys, over here it is house property. Now did you understand why I'm not applying the option for jewels? Because the option is only for immovable property. Okay. Then comes my third condition, which is the date of acquisition should be before 23rd July 24. Did we acquire before 23rd July 24? Yes, yes, yes. And condition number 4 is that the date of transfer should be on or after 23rd July 24. All my 4 conditions are fulfilled. If all your 4 conditions are fulfilled, you have one option. And what is the option, guys? The option is you can find capital gains with indexation, and whatever capital gains number you get, that number into 20% will be your tax rate. 12.5% without indexation, 20% with indexation. So all my 4, listen everybody, I'll repeat again. All your 4 conditions are fulfilled. So first of all, option will apply. In the option, what do? You calculate with indexation the capital gains number, that into 20%. So you have already calculated 12.5%. You will calculate the 20% number. Whichever is a lesser number, that is what you will ask your assessee to pay. So what do we have to calculate now? Capital gains for the house with indexation. Now see, because of indexation, will my full value consideration number change? No, because of indexation, only cost of acquisition, cost of improvement number will change. So I'll take the net consideration as it is. Okay, I'll take the net consideration 90 lakhs as it is. I will only do one change over here, index to cost of acquisition and index to cost of improvement. No cost of improvement over here, only cost of acquisition I'm going to index. What is the cost of acquisition? We've already done the thinking, 10 lakhs. 10 lakhs into CII of the year of transfer. What is the year of transfer in the question? 24-25. For 24-25, what is the index? 363. So 10 lakhs into 363 by, what is the year of purchase? Before 2001. So before 2001, you take the denominator index as 100. So 10 lakh into 363 by 100, you will get 36 lakh 30,000. So what is the capital gains with indexation? Capital gains with indexation is 53 lakh 70,000. Now on this capital gains with indexation, on this number what will be your tax rate? 20%. You're understanding? So whatever you have already calculated on that 12.5%, or with indexation recalculate, you got 53,70,000 on that 20%. How much will that be? 10,74,000. Now out of these two numbers, which number will you pay? Obviously you will pay whichever is a lesser number, which over here is 10 lakhs. So what will be your total basic tax? 10,18,750. I do have a lot of thinking more to do with you, but before I can do that, can I ask you one small question? When you compute total income, your LTCG number will be what? Will you consider with this 80 lakh number, or will you replace it with 53,70,000? You will not replace. Where am I doing? Are you noticing? Where am I doing all this calculation? Only inside the tax heading. When I'm computing my total income, my capital gains will still be what I calculated. You understanding everybody? See, this entire discussion with indexation, without indexation, whichever is lesser, all this will only be a part of my tax computation. It will not change my income computation. In income, I still have capital gains number without indexation only. Okay, so this is my total basic tax. Then I will ask you, can I please enjoy 87A rebate? Will you give me 87A rebate? You will not give me, guys, because your LTCG itself, if you see, is how much? Total LTCG itself is how much? Total LTCG itself is 81,50,000, which is more than 5 lakhs. So you will not have any 87A rebate, guys. 5 lakhs or 7 lakh, whichever regime assessee is following. Then will I have surcharge? I will definitely have surcharge. Income is more than 50 lakhs. More than 50 lakhs up to 1 crore. What will be your surcharge rate? 10% surcharge, guys. So 101875. No marginal relief. Income is far away from 50 lakhs. So after this, you will straight away add cess. How much will this be? You will get 1165,450. It's already in multiples of 10, so no need to do any rounding off also. Got it? Did we understand this part, everybody? Yes, so the most interesting part over here was the tax computation, because see, for jewels it's straightforward. I'll straight away take the 12.5% number. For immovable property, we do two calculations, 12.5% without indexation, 20% with indexation. But did you notice, did I straight away blindly apply the option? No, I checked my 4 conditions. Yes, all my 4 conditions were fulfilled. That is why I applied the option. And all this option and all is only in tax computation. In my total income computation, my capital gains number will still stay the same only, 80 lakhs and 1,50,000. Okay, the capital gains which I have calculated with indexation, this number is only for tax computation purpose. It will not be a part of my total income computation, no. Okay, so this was your capital gains question. This question gives you a nice understanding of the amendment. With this, you will be able to handle this option concept in the examination. Okay, I'll close this. Can I take you forward, please? Can we go to question number 8? Yes, come on. Question 8 is a nice set off and carry forward question, guys. It has a lot of interesting adjustments with respect to set off and carry forward. It's going to definitely be there in your examination. You will be having one question from set off or from clubbing. One nice 6-7 marks question you will be having. This question will prepare you for that one. Okay, we'll begin with this. So let's read the question and then we'll work it out. The question says, Mr. Akshay, he is a resident individual. He provides the following details of his income and losses for the year. So they've given us nice 13 adjustments. He has given us some brought forward losses as well. Compute total income of Mr. Akshay for assessment at 25-26 and the amount of loss that can be carried forward. Mr. Akshay has opted out of the default tax regime. So your computation will be as per the normal provisions, guys. The question says assessee is opting out of the default tax regime. So as per the normal provisions, as per the regular provisions, you can compute the income. Now come on, let's begin. Now there is a certain format in which I generally solve the set off and carry forward questions. We'll keep all the losses in the margin. We'll handle them separately. We'll finish all the incomes first, okay? So come on, let's begin. Answer to question number 8. We have income from salary computed 35,20,000. Okay, so we have salary income. How much? 35,20,000. Why have they said computed? Computed means deductions and all, section 16 and all, everything they've already done. This is your final taxable number. Then they've mentioned rent received from house in Delhi. Rent received from house in Delhi. Have they given you IFHP number? No. They've given the rent number. So from this we have to subtract section 24 deductions. Basically rent is going to become your GAV. They have only given GAV. Everything else we have to do. So repayment of loan taken for purchase of the above property. So they have given us, even this is relating to this property. Then rent from house property in Jaipur. So even this is relating to IFHP. Then interest on loan taken for repair of house in Mumbai and Delhi. This is also relating to IFHP. So you have 4 adjustments in relation to IFHP. How many houses is your assessee having? He is having 1 house in Delhi, 1 house in Jaipur, and then 1 in Mumbai. Totally 3 houses he is having, guys. So let's create one proper IFHP working note itself. We have 3 houses. We have a Delhi house, we have a Jaipur house, and then we have a Mumbai house. So how to start? We'll start with, let's make a format first. From GAV, we will subtract municipal taxes paid and we will get the NAV number. Then from this we will subtract deductions under section 24. How many deductions? 2 deductions. Number 1, standard deduction. Number 2, interest on borrowed capital. Interest on borrowed capital, immediately 2 things will come to your mind. Pre-construction interest and current year interest. And that is how we will get our IFHP number. Okay. Now let's begin house by house. Rent received from house property in Delhi, 5 lakh rupees. So I'll put that over here for GAV of the Delhi house. This adjustment is done. Then repayment of loan taken for purchase of the above property. Loan was taken from a friend. So who is a lender over here? Friend is the lender. This repayment includes payment of interest of 7 lakhs. So totally how much are we repaying? 15,25,000, out of which interest is 7 lakhs. So what about the balance 8,25,000? That will be principal repayment. Let's handle step by step now. What to do with this interest of 7 lakhs? IFHP section 24, guys. So interest on borrowed capital, I have 7 lakhs. Then what about the principal repayment 8,25,000? This will go to section 80C. But be careful. Under section 80C, when can you put the principal repayment, guys? 3 conditions are there. Condition number 1, it should be a residential house property. Is it a residential house property? Yes, guys, it's a house property. I'll assume it is residential. Then condition number 2, the loan should be for purchase or construction. Yes, the loan was for purchase. So even this condition is fulfilled. And the third condition, guys, we have to be careful about who the lender is. The lender can be a bank, housing finance company, national housing bank, LIC, employer, central government, state government. All this can be the lender. Here, lender is a friend. With friend lender, will you get ATC, guys? You will not get ATC, and therefore for the principal repayment, no section 80C. So only the interest part alone I will get under section 24, and I've put the amount over here. Story over, guys. This is it with this adjustment over here. Now come to the next adjustment. You understood, right? The interest component I took to IFHP. Principal component ideally goes to section 80C. Principal component ideally goes to ATC, but you can put under ATC only the lender is bank or financial institution or national housing bank or central government, state government, employer, LIC. Here lender is friend, so you can't put under ATC. Okay. Then come to the fourth adjustment over here, rent from house property in Jaipur. So Jaipur rent also they have given to us 3,20,000. This will become our GAV. Then interest on loan taken for repair. This is a repair loan of house property in Mumbai also, Delhi also. So Delhi house also, Mumbai also, we have a repair loan. The property in Mumbai is self-occupied. So this Mumbai property is self-occupied. Delhi and Jaipur properties are let out. The loan was taken on 1st April 2017, was utilized in 50-50 ratio for house properties in Mumbai and Delhi respectively. So total 1,50,000 is the interest on repair loan. Out of this, how much is for the Delhi property? 50-50 they are saying, guys. 7,50,000 will be for the Delhi property, and for the Mumbai property the balance 75,000. So 75,000 for both the properties you will have. Okay. Now Delhi property is anyways let out property. So it's okay. Full interest we can take. We already had 7 lakh interest. Now we are having one more 75,000 interest. So total interest over here will become 7,75,000. But the Mumbai property is a self-occupied property. Self-occupied property, you have two limits. You have 2 lakh limit, 30,000 limit, two limits you have. And if the loan is taken for purchase construction, then only you get the 2 lakh limit. Here the loan is taken for repair. So the applicable limit will be 30,000. So 75,000 interest, but I will restrict it to 30,000. Okay guys, so now with this I can finish off my whole IFHP calculation. No municipal taxes paid. So this 5 lakhs number, this 3,20,000 number will become your NAV. Mumbai house is self-occupied. Self-occupied NAV is always 0. Then put the standard deduction. Standard deduction you will get 1,50,000 here. And for the Jaipur house, 96,000. For the Jaipur house we did not have any interest. So find the net number guys. How much will you get? You will get a negative 4,25,000 for the Delhi house. You will get 2,24,000 for the Jaipur house. And you will get a negative 30,000 for the Mumbai house. So if you find the net number, if you adjust everything against each other, what's your net IFHP number? Minus 4,25,000 plus 2,24,000 minus 30, you will get a negative 2,31,000. So can I say that I have, in my margin over here, can I say I have loss from house property 2,31,000? All losses in the margin guys, we'll handle them separately later. Understood? This is the most important adjustment in this question guys, the whole IFHP working note. I'm hoping you understood this. Yes, the interesting part over here is self-occupied property. Self-occupied property repair loan maximum only 30,000 I will allow. But let out property, no limit. Okay, so this is it about your first part, your IFHP part. Now come on, let's go forward. LTCG on sale of equity shares STT paid. LTCG equity shares STT paid. What kind of LTCG is this? 112? 112A LTCG, 7,95,000. So I'll make a note, LTCG section 112A, 7,95,000. Then we have FD interest 73,000. Which head of income guys? IFOS. So under IFOS we have FD interest of 73,000. Now as soon as I write FD interest, something come to your mind. ATTT B. But ATTT B is only for senior citizen, super senior citizen. Question doesn't say assessee senior citizen or super senior citizen. So no ATTT B. Now can you put FD interest in ATTT A? No. ATTT B only covers FD interest. But ATTT B is for senior citizen, super senior citizen. Assessee is not that. So no ATTT B. ATTT A covers only savings interest. This is FD interest. So therefore no ATTT A also, nothing. Okay. Then we have loss from textile business. Normal business loss guys. So I'll put it in the margin. Business loss 7,50,000. Okay. This is also done. Then we have speculative business income 2,30,000. I'll open the PGBP head. So under PGBP head we have speculative business income, how much? 2,30,000. Even this is done. Then we have lottery income. Where will lottery income go? Which head of income? IFOS. And why have they mentioned gross? It's before TDS. Had they mentioned it as net, I would have had to gross it up. They've already mentioned gross, so I'll take this number as it is. So we have lottery income of 75,000. Remember guys, against casual income, you can't adjust any loss. You can't adjust any expense. Untouchable income this is. Then we have loss incurred by firm in which he is a partner. You tell me, if it was share of profit from a partnership firm, what you would have said? You would have said it is exempt. So from the same source, if you have a loss, what do you do with the loss? You will simply ignore the loss. Then salary received as a partner from partnership firm allowed to the firm. Which head of income? Salary from partnership firm, PGBP head, 50,000. Whatever is allowed for the firm will be taxable for the partner. Question says it is fully allowed for the firm, so fully taxable for the partner. Then, life insurance premium paid for son, 30 years of age and working in US. Life insurance premium you will get section 80C. So I'll keep a note of this in my margin. I have 80C of 15,000. Then he has the following brought forward losses. Brought forward STCL 2,75,000. I'll keep the brought forward losses separately. Brought forward STCL 2,70,000. Then we have brought forward loss on sale of equity shares 111A 25,000. Guys, even this is STCL. 111A is what? 111A is also short term only. So even this is STCL. So what's your total STCL? Total STCL is 3 lakhs. Okay, I will not differentiate between them because short-term capital loss is short-term capital loss. Whether normal or 111A doesn't matter. Okay, so that is it with the question. I've written all my losses in the margin. So can we start with our set off and carry forward game now? Yes, we always adjust which losses first. Current year losses first, only then we come to brought forward losses. In current year losses, I always make you do intra-head first. Loss from house property intra-head is not possible anymore. You've already done intra-head, that was possible. Beyond that, not possible. Business loss is intra-head possible. Yes, I do have business income, guys. Against this, I can adjust. So I can adjust maximum 2,80,000 only. So my PGBP will become 0. And how much business loss am I still left with now? Out of 7,50,000, I was able to adjust 2,80,000. I still have 4,70,000 left. So with this, I am done with my intra-head adjustment current year loss. Then current year loss, I will do inter-head adjustment. Inter-head means what? Against other heads. Now whenever you have both of these losses, which of them do you always adjust first? I had given you this tip multiple times even earlier. We always do business loss first. Why? Because business loss is a restriction, guys. It can't be adjusted against salaries. But loss from house property can be adjusted against any head of income, can also be adjusted against salaries. So therefore, business loss, there are lesser options. So in inter-head adjustment, we will do business loss first. Okay. Now business loss, what are the options? Check first. Don't straight away adjust wherever you want. Check what are the options. Can you adjust against salaries? No. Business loss. Can you adjust against 112V LTCG? Yes, you can. Can you adjust against FD interest? Yes, you can. Can you adjust against lottery income? No. No losses can be adjusted against lottery income. Now you carefully think and tell me, out of these two options, where will you adjust first? Where will you adjust first? Apply common sense. Apply brain. Tell me. Where will I adjust first? See guys, this 112A LTCG, what are the tax rates possible? If it is before amendment, what is the tax rate possible? Before amendment, 10%. After amendment, 12.5%. These are the rates, guys. But this FD interest is normal rate FD interest. If you look at the normal rate of the assessee, normal rate income of the assessee is more than 10 lakhs, 35 lakh, 20, 73,000 and all, more than 10 lakhs. So 30% slab rate, guys. So it is better for me to adjust where? Against FD interest over here. Because this is only 10%, 12.5%. This is 30%. I will prefer to adjust over here first. So don't have, that's why I keep telling students, I don't know why you all think that first to adjust against special rate. There is nothing like that. See, where is the tax rate higher? Adjust there first. That is your criteria. Tax rate is higher over here. I will adjust over here first. So I'll adjust my business loss 73,000. Okay. So how much business loss am I still left with? I'm still left with 3,97,000. So this 3,97,000, what is the only option I'm left with now? The only option I'm left with is 112 LTCG. So I'll adjust it over here. Business loss 3,97,000. With this, how much LTCG am I still left with? I am still left with 3,98,000 LTCG and my business loss is fully adjusted. Understood everybody? Yes, inter head of business loss I have completed. Now tell me, loss from house property I want to do inter head. Maximum how much you will let me do? Loss from house property, see, had it been 115 BAC, what you would have said? Had it been 115 BAC, you would have said only intra head allowed. No inter head, no carry forward, no brought forward, nothing. But this is normal regime, guys. So you will allow interhead, but interhead maximum 2 lakh you will allow. Now what are my options? Same thing I will ask you, what are my options? I have 2 options, guys. Against salary also I can adjust. Against 112A also I can adjust. Can I adjust against lottery income? No. No other income I have. Now out of these two, what would you prefer? This is going to be 10%, 12.5%, but this is going to be 30%. So obviously this is better, guys. So I will adjust my loss from house property against salary, but only 2 lakhs I will adjust. I still have how much loss left? 31,000. Assessee carry forward. Okay. Now how much is your net number from salaries? You will get 33,20,000. Now tell me, what about my brought forward STCL? STCL you can adjust against what? STCG or LTCG. I do have LTCG, guys. STCL can be adjusted against STCG or LTCG. I do have LTCG. I'll adjust my brought forward STCL over here, fully adjusted. So how much LTCG are you still left with? You still have 98,000 LTCG left. So what are the losses you're going to carry forward, guys? 2 losses we will carry forward. We will carry forward loss from house property 31,000. Only one loss. Only one loss we are carrying forward. Loss from house property 31,000. Only one loss we are carrying forward. So that's it. Try to close the question now. What's your IFOS number? 75,000. And how much is your GTI now? GTI will be 34,93,000. Now you remember we have chapter 6A. In this question, we have ATC of 15,000. Chapter 6A, I can adjust against what? Only against normal rate income. Here, I have special rate incomes. What are my special rate incomes over here? I do have this 98,112 LTCG, no, special rate income. Even the 75,000 is lottery income, special rate income. So, I will split my GTI into 2 parts. Special rate income and normal rate income. In special rate, I have 2 numbers, 98,112 LTCG, 75,000 casual income. So 1,73,000 is my special rate income. What is my balance normal rate income now? 33,20,000. So I will subtract my chapter 6A of 15,000 against normal rate income only. So my net normal rate income will be 33,05,000. Special rate income will be 1,73,000. So the total income of my assessee will be 34,78,000, which is already in multiples of 10. So no need to do any rounding off also. See, this is one small point which many of us forget in the exam, to split. Remember, chapter 6A you will enjoy only against normal rate income and not against special rate income. So split and adjust chapter 6A only against normal rate income. Alright guys, comfortable? So in this question, if you see, we had one major learning that when we have multiple options, please select that option which will reduce your tax liability. Adjust loss first against those incomes which have a higher tax rate. Okay guys, yes, come on, let's not slow down. Everybody is comfortable with this question, right? Set off in carry forward. Now let's go ahead guys, come on, let's go to question number 9. Question number 9 will help us with TDS. 2 interesting discussions will get covered over here. One with respect to TDS and the other with respect to TCS. Let's discuss them both. Come on. The question says, Mr. Subhash is a salaried individual. He pays rent of 52,000 per month to Raj from April 2024. Mr. Subhash vacated the premises on 31st August 24. Till here, let's handle the question. First of all, rent. For rent, how many sections do you have? 2 sections I have. 194I and 194IB. 2 sections I have. In this question, 194I will not apply. Why? There are two reasons. Reason number one, he's a salaried individual. So whatever rent he's paying, don't you think it will be house rent? It will be personal rent. For personal expenses, 194I will not apply. Second reason why 194I will not apply, 194I is an R hijack section. So because it is R hijack section, if the deductor is an individual, his preceding previous year turnover should be more than 1 crore, preceding previous year gross receipt should be more than 50 lakhs. But he is a salaried individual. Forget about 1 crore turnover. He will not even have any turnover. So that is the reason why 194I will not apply. So first of all, which section are we thinking of? We are thinking about section 194IB. Okay guys, now in 194IB, what is your limit? Monthly rent. Monthly rent has to be more than 50,000. Yes, it is more than 50,000. Now see, I'll explain it to you over here. I'll put it for you over here, okay? If you want to enter into 194IB, you have to first fulfill some checkpoints. Checkpoint number 1, section 194I is not applicable, which itself means out of these two sections, which section is priority section? 194I. Only if 194I is not applicable, only then I come to 194IB. Then comes your checkpoint number 2. Why is 194I not applicable? Either because it was a personal transaction or because preceding previous year turnover was within 1 crore or preceding previous year gross receipt was within 50 lakhs. I have the word or, but over here both are fulfilled. Then comes my third condition, the deductor should be individual or HUF. 194IB will apply only to individual or HUF. Yes, it is individual or HUF. And condition number 4, your last condition is that it should be rent relating to land building. It should not be rent relating to plant and machinery, furniture and all, because 194I will cover rent on furniture also. It will cover rent on plant and machinery also. But 194IB is only covering rent on land and building. Okay, here if you see all 4 conditions are fulfilled, 194I is not applicable. It is not applicable because of both of these reasons. Then yes, the deductor is individual or HUF. Yes, it is rent relating to land building. So if all conditions are fulfilled, you will look at the monthly rent. The monthly rent should be how much? The monthly rent should be more than 50,000. Yes, over here monthly rent is more than 50,000 guys. It is 52,000. Okay. So if all these conditions are fulfilled, 194IB will apply. But 194IB, when do you deduct guys? In the last month, in the month of March, or if you are vacating the property in between the year, whenever you vacate the property. When are you vacating the property? August. So therefore, August month rent is how much? 52,000. From this month's rent only you will subtract TDS. Now tell me, you have paid rent for how many months? April, May, June, July, August, 5 months. What's the TDS rate? Tell me. TDS rate 5%. You know, right? In section 194IB, there's an amendment, guys. Amendment is with effect from when? Amendment is with effect from 1st October 24. If you're deducting tax before 1st October 24, your TDS rate is 5%. If you're deducting tax after 1st October, on or after 1st October 24, your TDS rate is 2%. Here, when are we deducting? In August month. So before 1st October, we are deducting, TDS rate will be 5%. So 52,000 rent for 5 months, 5% will be how much? 13,000 TDS. So August month, how much amount will the tenant give to the landlord net? Net he will give 39,000. So August month, what is the TDS now? The TDS is 13,000 everybody. This is going to be my first subdivision, that 13,000 TDS will be deducted. Till here did we understand? August month rent, in the last month only we will deduct TDS. We paid rent for 5 months, 5% TDS rate. Okay. Now they are making one small change in the question. They are asking, what if he vacates a premise on 31st October? So in that case, when will you deduct tax guys? You will deduct tax in October. So October month rent is 52,000. From this you will subtract TDS. Now 52,000 rent you paid for how many months? April, May, June, July, August, September, October. You paid rent for 7 months. But now you are deducting tax on or after 1st October 2024. So because they are deducting tax on or after 1st October 2024, what will be your TDS rate over here? Your TDS rate will be 2%. So 52,000 into 7 months into 2% will be 7,280. So what will be the net rent which we will pay for the month of October, 44,720. So your TDS in this case will be 7,280. Yeah, so this is it about your first subdivision, guys. Two situations he had given to us. If he vacates in August, this is going to be his TDS. If he vacates in October, this is going to be his TDS. If you are deducting tax before 1st October, 5% TDS. If you are deducting tax after 1st October 24, 2% TDS. Okay. Now coming back to the question, this was your first subdivision. Come to the second subdivision now. ABC Traders, a partnership firm, is engaged in wholesale business of tendu leaves. Turnover for 23-24 was 9 crores. During financial year 24-25, it sold tendu leaves worth 12 lakhs to XYZ Limited. XYZ Limited does not provide PAN to ABC Trader. So this is going to be tendu leaves. So obviously which section? TCS will apply, guys. TCS section 206C1 will apply. So first I'll draw a diagram for you over here to explain the section. See, I have the seller on one side. I have the buyer on the other side. The seller has sold to the buyer atoms. What are the goods over here? Atoms. Atoms stand for A for alcoholic liquor for human consumption, T for tendu leaves, another T is for timber, O is for other forest produce, M is for minerals like coal, iron ore, lignite, and S is for scrap. Okay, the seller should be a person who, see, either the seller will be an individual or HUF, or the seller will be any other person. If he is individual or HUF, his preceding previous year turnover should be more than 1 crore, or his preceding previous year gross receipt should be more than 50 lakh, or he should be any other person. The buyer should be a person who has not given 206C1A declaration. You know, right? When do you give 206C1A declaration? If you are going to use the goods for further manufacturing. If you are going to use the goods to generate power, you can give declaration. If you give declaration, then there will be no TCS at all. So the buyer should not have given 206C1A declaration. If the buyer gives the declaration, then no TCS at all. So these are your conditions over here, guys. Now in this question, who is the buyer, who is the seller? ABC Traders is the seller. Now ABC Traders is the seller. So here, tell me everybody, will you even check all this? No, I will check all this only if the seller was individual or HUF. Here ABC Traders is a partnership firm. So I will not even check all this. So seller condition is fulfilled. Then what are we selling? Tendu leaves. So even this condition is fulfilled, that yes, goods are atoms. And does the question say buyer has given any declaration? No, buyer has not given any declaration. So all my conditions are fulfilled. So first of all, which section will apply? 206C1 will apply. In 206C1, what's the TCS rate? See, I'll tell you. For tendu leaves, it is 5%. Okay. For TO2, it is 2.5%. Everywhere else, it is 1%. So tendu leaves, what is the TCS rate now? 5%. But however, the question says the buyer XYZ Limited is not providing PAN. So if the buyer is not giving PAN, not giving Aadhaar, then section 206CC will also apply. If no PAN, no Aadhaar. Now 206CC says the rate will change. The rate will become 2 times of the applicable rate, or 5%, whichever is higher. But it should not exceed how much? It should not exceed 20%. Okay. So what is 2 times of the rate, guys? 206C1 for tendu leaves. Generally, what is the rate? 5%. So 2 times of the rate will be 10%. 10% or 5%, whichever is higher. 10% will be the TCS rate now. So what is the value of the goods? Tendu leaves worth 12 lakhs. So 12 lakhs into 10%, 1,20,000. This will be the TCS amount under 206C1H in this question. You got it, everybody? Interesting. So this is application of 206C1. So because it is tendu leaves, 5% TCS rate. But because the other party, the buyer, has not given PAN, See, you can't ask for Aadhaar. Buyer is a company. For company and all, no Aadhaar. Only PAN card they will have. So, buyer is not giving PAN Aadhaar. 206cc will apply. 206cc says 2 times the rate or 5%, whichever is higher, but maximum 20%. So, 2 times the rate is 2 times of 5%, 10%. So, 10% or 5%, whichever is higher, clearly 10%. So, 10% will become your new rate now. So, 12 lakh was a worth of goods. 12 lakh into 10%, 1,20,000 becomes 206C1C TCS. Okay, so this was your question on TDS and TCS. And now I'll take you to the last question. I think this is the last question. Yes, the last question in your RTP discussion. You have your total income question now, your full-fledged total income question with a lot of learnings. Are you ready? Can we start this up now? Yes, especially with respect to scientific research, you're going to have one amazing learning, guys. Let's begin. Give me your best possible version. Absolutely no silly mistakes. Let's see how nicely we can handle this question. Listen now. What does the question say? Mr. Ganesh, resident and ordinarily resident, 61 years. What can you conclude at this stage? Mr. Ganesh, you're a senior citizen. Why? He's an individual. He's at least 60 years. He's a resident. So he will become a senior citizen. He is engaged in the business of manufacturing. So because manufacturing, immediately what comes to your mind? Additional depreciation comes to your mind. He is manufacturing furniture. He is subject to tax audit. 1 second. The question says he's subject to tax audit. So what will be his 139(1) date? Obviously, his 139(1) date will be 31st October 25, guys, because tax audit. Then he has provided the following information. They've given us a P&L account. We have the net profit number. They've given us 7 adjustments. Compute total income and tax liability, both total income and tax liability for assessment at 25-26, assuming he wants to pay tax under 115 BAC. So we have to do the computation as per the default regime, guys, as per 115 BAC. I will do the entire computation for you over here. I would request try to solve with me. Okay, so answer to question number 10, we have to do 2 things. We have to compute total income and tax liability, but as per 115 BAC, as per the default regime. Let's begin. Come on. Let's start with the P&L account. So we have the P&L account with us. We have the net profit number with us. So of course we will have PGBP. Now to compute PGBP, will I use a direct method or will I use indirect method? I have the net profit number. Therefore to compute PGBP, I will use the indirect method. Indirect method means what? Indirect method means the 5 steps I will use. So I'll write over here PGBP. I'll give reference to working note number 1. I'll open working note number 1 with the heading PGBP. So here I'll start with net profit as per P&L account. Then I'll add expenses which are debited but not allowed. Then I'll add incomes not credited but taxable. Then we'll subtract expenses not debited but allowed. And finally we'll subtract incomes which are credited but not taxable. Okay, so I've made my 5 steps. Now let's start with the adjustments one by one. We always start with the credit side first, guys. So gross profit, nothing to do with gross profit. Winning from lottery net of TDS 30%. What should I do in PGBP? This is not business income, guys. I have to remove this from PGBP. How will you remove a credit? You will remove a credit by subtracting it. So I'll remove this from PGBP. So less income. It's an income which is credited but not taxable. Under this lottery income 31,500, I'll remove from here and I'll take it to which head? I'll take it to the IFOS head. IFOS head, I'll create another working note number 2, IFOS. So here we have lottery winnings. Guys, they have given us the net number. We have to gross it up. So how will you gross it up? What's the TDS rate on winnings from lotteries? 194B, guys, 30%. So 31,500 into 100 by 70, how much will this be? 45,000. I will take it to the IFOS head. Now here they have not asked for tax payable. If they had asked for tax payable, then I would have taken TDS credit also over here. They asked for tax liability. They didn't ask for tax payable. So I will not talk about TDS credit over here. So what's your IFOS number now? 45,000. Done, guys. Then after this, what about bad debts recovered? Bad debts recovered is taxable under PGBP. It is taxable under section 41. It is taxable. It is already credited in the P&L. Nothing left for me to do. Admin expenses, salary and wages, interest on loan, depreciation I'll assume as per Income Tax Act, professional fees, nothing to do, guys. Rent, rates and taxes, travel and conveyance, nothing to do. What about this loss on sale of asset of scientific research? See, this I will reverse because you can't debit the loss in your P&L account. There's a separate provision altogether for this. I'll explain it to you. So this I have to remove from P&L. How do you remove a debit? You'll remove a debit by adding it. So add expenses. It is debited but it is not allowed. So loss relating to your scientific research asset. How much is it? 2 lakhs. I'll remove it from my P&L. I'll add it back. And what's your net profit number? 53,74,500. Okay. Till here it is all done. Now come to the other information. Now listen to this carefully because in the solution there is a small mistake which ICAI has done in this regard. So your answer will change also because of this subdivision. So listen carefully. The question says opening stock and closing stock of finished goods were undervalued by 10%. Undervalued by 10%. Opening stock of 14,50,000 and closing stock of 15,58,000 was shown. See, I'll handle this for you step by step. See, let's talk about opening stock over here. What is the opening stock which is shown in your trading and P&L account? 14,50,000 was shown. But they are saying that it is undervalued by 10%. So this 14,50,000 is what? 90. It is undervalued by 10%. No, so this is only the 90% number. So what is the proper opening stock? What is 100% of opening stock? 14,50,000 into 100 by 90. How much will you get? 16,11,111. So this is your real opening stock number, guys. But this is a number which is debited to the P&L. So what is the number which is not debited to the P&L? What is the number which is not debited in the P&L? The difference 1,61,111. This is the number which is not debited in the P&L. Are you all listening to me? This is, see, I want you to listen carefully because everybody on YouTube is giving their own explanations for this. But I'm telling you exactly the correct explanation because if you look at the solution, okay, ICAI has given the correct number in the computation. But the final number which they have written is wrong. See, I'll show you over here. I'll show you. Where is it? Here. See, this calculation they have given correctly. Here they have put one extra zero. So everybody is still taking this number only, which is actually wrong. Because on the basis of this calculation, you will not get this number. Okay. So I am explaining to you in the correct way. According to this calculation, I am explaining to you. So listen to me carefully. I'll come back to this. So where did it go? Here. So 14,50,000, this is what is debited to the P&L. This is a real number. So what is not debited? This is the number which is not debited. So I have to now debit this. So what will you do in your PGBP computation? I have to now debit this. So you will subtract this, guys. Okay. Now same way, let's think about closing stock. What is a closing stock number which is given in the P&L? Closing stock of 15,58,000 was shown. So the closing stock number which is shown in the P&L is 15,58,000. But again the same thing, it is undervalued by 10%. So this is 90. So what is the real value of closing stock? 15,58,000 into 100 by 90. You will get 17,31,111. So this is the number which is credited in your trading and P&L account, but this is the number which should have been credited. So what is the number which is not credited in your trading and P&L account? 1,73,111. This is the number which is not credited in the P&L account. You have to now credit it. So how will you now credit it? You will add it. So opening stock undervaluation subtract, closing stock undervaluation add. So, and I'll give you one small hint, okay? In the examination, if you get confused whether you should add or subtract, remember this. Opening stock overvaluation add. If you remember this OO add, everything else you will be able to answer. Opening stock undervaluation, you will automatically do ulta. You will subtract. So closing stock, opening stock overvalued, you're adding. So obviously closing stock overvalued, you will do ulta. You will subtract. So closing stock undervalued, you will add. So over here it is undervalued, right? Opening stock is undervalued, even closing stock is undervalued. So opening stock undervalued, you will subtract. Closing stock undervalued, you will add. So both of these numbers let's handle now in your PGBP. In the last part, after your incomes point, last point I'll write down over here, less opening stock undervalued, add closing stock undervalued. So opening stock undervalued, your number is 1,61,111, and closing stock undervalued, your number is 1,73,111. So closing stock undervalued I will add, opening stock undervalued I will subtract. Logic I explained to you over here, but if you want a shortcut, you can use this shortcut also. Okay, so if you see what's a net number, 12,000 you will get, but ICI in its solution they have given 1,20,000. That is wrong. Okay, so the computation they gave correctly, but the number they put wrongly in the outer column. It should be 12,000 only actually. Okay, so this is it about your first subdivision. Now come to the second subdivision, guys. Salary and wages include the following items. Contributed 20% of basic salary in NPS referred in 80 CCD regarding salary paid to an employee, Mr. Ramesh. Clearly tell me, is this assessee's contribution for himself or is this for employee? Is assessee contributing into NPS for himself or is he contributing for employee? He is contributing for employee. Now listen to me everybody. So he is contributing 20% of basic salary in NPS referred in 80 CCD regarding salary paid to an employee, Mr. Ramesh. So for Mr. Ramesh, for an employee, your assessee is contributing. So don't you think any expense you have for employees, this will become an expense relating to your business or profession, guys. This expense in PGBP, it will be allowed. But tell me, maximum how much will be allowed over here? Maximum 14% of salary of the employee will be allowed. And salary will have two components over here, basic salary plus DA forming part. Okay, see, no 80 CCD, no chapter 6A over here, because your assessee is not employee, assessee is employer. So employer makes any contribution for employee. For the employer, it's an expense relating to business or profession. So under PGBP, it will be allowed maximum 14% of salary. Earlier it was 10% of salary, guys, but your examination, May 2025 examination onwards, it has been amended to 14% of salary. So he contributed 20% of basic salary in NPS referred in 80 CCD, salary paid to an employee Ramesh, who has withdrawn basic salary 5 lakh, DA is 40% of basic salary, 50% of DA is forming part. So come on everybody, tell me what is the actual contribution now. Actual contribution is 20% of basic salary. Basic salary is 5 lakhs. So actual contribution is 5 lakh into 20%, which is how much? 1 lakh. Okay, but how much will you allow? 14% of salary. Salary will mean what? Basic plus DA forming part. So basic is 5 lakh. DA is 40% of basic salary. Out of that 50% is forming part. So DA forming part will be 1 lakh. So you understood how 1 lakh, I'll put for you over here. 5 lakh is basic salary. This into 40% is DA. Out of this 50% is forming part. So what is total salary for the purpose of NPS? 6 lakhs. So this 6 lakhs into 14% is what you will allow. 6 lakh into 14%, 84,000 is what you will allow. But how much has assessee debited in P&L? 1 lakh. But how much you will allow? 84,000. So how much extra he has debited? Extra 16,000 he has debited. Extra debited, how will you reverse extra debited? Extra debit, how will you reverse? You will add back. So you will add 16,000. Extra 16,000 is debited, no? So you will add back that extra 16,000. So employer's contribution to NPS, 16,000 I'll add back. Okay, you understood how I got the 16,000? We should have actually allowed only 84,000, but we have allowed 1 lakh. So the excess of 16,000 is what I'm reversing over here. Okay, so this is your first subdivision. Then the question says, some of the employees opted for retirement under VRS. 3,40,000 was paid to them on 1st Jan 2025. VRS, what do you do, guys? It is allowed on payment basis. Yes, assessee has paid, but it is allowed across how many years? Across 5 years, guys. So we have debited full 3,40,000. So actual debited is how much? Actually, we have debited 3,40,000, but maximum how much will you allow? Maximum you will allow only 1/5. So 3,40,000 divided by 5, only 68,000 you will allow. So how much excess you have debited? You have debited excess of 3,40,000 minus 68,000. You have debited excess 2,72,000. How will you reverse excess debit? You will add it back. So add expenses debited but not allowed, VRS. We debited 3,40,000. We should have debited only 68,000. So excess that we debited 2,72,000 I will add back. Simple, guys. Understanding? Yes, this is your VRS adjustment. Then remember we had interest. We had interest over here, 7,50,000. They're giving information about that now. So interest includes interest at 15% per annum on loan of 12 lakhs, which was taken from SBI on 1st May 2022 for purchase of new electric car of 15 lakhs. Car is used for personal purpose. No amount is repaid so far. Guys, what to do over here? Car is used for personal purpose. So what will you do with the interest? You will reverse the interest. Wait, don't straight away go to ATEB. Step by step. First PGBP, what I should do? In PGBP, it's a personal expense, right? I should remove it from PGBP. It's already debited. How will you remove a debit? You will remove a debit by adding it. So you will add how much? How much is the interest? See, you took a loan of 12 lakhs. So 12 lakhs loan into 15% interest. Okay, how much will that be? 1,80,000. So you will first have to add 1,80,000. Then you will, after this only you will come to chapter 6, say ATEEB. But no ATEEB also over here because assessee is following 115 BAC. No, under 115 BAC you don't allow chapter 6 say other than ATJJAA, ATCCD subsection 2, ATCCH subsection 2. So ATEEB and all you will not get under 115 BAC. Okay, that is why no ATEEB. Otherwise, yes, if it was normal regime, I would have given an ATEEB. So for now, I'll just add back your interest on electric vehicle loan. Why am I adding it back? Because the car is used for personal purpose. So it's not a business expense. So 1,80,000 I'm adding back. This is also done. Then comes your next adjustment. How 11 months? No, not 11 months because loan was borrowed on 1st May 2022 in the year 22-23. Current year is 24-25. Current year 24-25 loan is fully outstanding. So therefore, I will not do 11 months calculation, full 12 months only because right now it's 24-25. Then comes your next adjustment. Depreciation as per income tax is 4,50,000. Oh, which means the depreciation which we have over here is not as per income tax. I'll reverse it. How do you reverse a debit? You will add it back. So depreciation as per Income Tax Act, how much? 6,17,000. I'll reverse it. I'll add it back and I'll subtract depreciation as per Income Tax Act. How much is depreciation as per Income Tax Act? 4,50,000. But wait, but during the calculation, the following addition was not considered. Motor car was not considered, purchased for 3 lakhs for supply of finished goods to dealers on 25th August 24. So on this, they have not calculated depreciation. So let us now calculate 3 lakh into what's the depreciation rate for car? 15%, guys. It was purchased on 25th August 24. Let's say put to use on the same day. Definitely put to use for at least 180 days. So I'll get full year's depreciation, which is 45,000. No additional depreciation over here because of two reasons. Reason number one, default regime. In 115 BAC, no additional depreciation. Reason number two, for motor vehicles, no 115, no additional depreciation. So therefore, no additional depreciation, only normal depreciation you will have 45,000. So what will be your total correct depreciation now as per Income Tax Act? 4,50,000 plus 45,000, which is going to be 4,95,000. Understanding? So depreciation as per Income Tax Act 4,95,000. Simple. Then an asset was purchased. This is interesting. Okay, come on, sit up straight and listen to me carefully. An asset was purchased for 6 lakhs on 23rd July 21 for conducting scientific research. So that year, how much deduction you would have enjoyed? That year, 21-22, when you purchased 6 lakhs, you would have enjoyed Section 35 deduction. The deduction was claimed under Section 35. This asset was sold on 5th September 24. Current year, it is sold for 4 lakhs. Guys, will you listen to me? I'll explain the whole concept to you guys. Nicely, you will understand. One explanation you will understand. It's a very simple concept. See, whenever you sell a scientific research asset, there will be two tax treatments. Okay. Tax treatment number 1 will be in PGBP head. Tax treatment number 2 will be in capital gains head. So there will be how many tax treatments? There will be 2 tax treatments. In PGBP head, what will you do? 2 things you will compare. When you purchase the asset, you would have enjoyed Section 35 deduction. So how much deduction you enjoyed under Section 35 in this question? 6 lakhs you enjoyed. You will compare that number with the selling price number. What is selling price number, guys? We sold it for how much? 4 lakh rupees. Okay. Now out of these two numbers, whichever is a lesser number, which is a lesser number? 4 lakhs. This number will be taxed for you as PGBP. Step 1, very simple. Whether you know this, whether you don't know this, one time if you listen to me, one explanation you will be sorted. PGBP part is simple. When you purchase the asset, whatever Section 35 deduction you enjoyed that, or whatever you're selling it for, whichever is lesser will be your PGBP, guys. Then listen, after this you will have capital gains. Okay, normal usual capital gains calculation. How do you do capital gains calculation, guys? You start with capital asset transferred. What is a capital asset transferred over here? Plant and machinery, which is used for scientific research. Then what is a period of holding? Tell me, when did you buy it? You bought it on 23rd. One second. Yeah, you bought it on 23rd July 2021. And when are you selling it? 5th September 24. Then what do? You always pause, check, think. Is this period before the amendment, after the amendment? It is on or after 23rd July 2024, guys. After 23rd July 24, how many things you will write now? 4 things. 50 AA will have 4 assets. Is it market linked debentures? Is it units of debt oriented mutual fund? Is it unlisted bonds? Is it unlisted debentures? None of it, guys. So therefore, first of all, 50 AA will not apply. Then how many periods of holding you will have? 2 only, 12 and 24. For this, the period of holding will be 24 months. Then will you give me indexation benefit? No indexation after the amendment, guys. And if at all I have to compute tax, you'll have 2 rates, 12.5% and 12.5% and 20%. 12.5% will be for long term, 112 and 112A, and 20% will be for short term, which is Section 111A. These are your 4 points. Now tell me, is this period more than 24 months? Yes, it is clearly more than 24 months. So therefore, what kind of an asset? Long term. See, some of you will be thinking now, ma'am, depreciable asset, plant and machinery, always short term. Are you thinking like that? You can't think like that, because tell me, if you have claimed Section 35 earlier on that same asset, would you have claimed depreciation? On that same asset, you would not have claimed depreciation. No. So is this a depreciable plant and machinery? This is not a depreciable plant and machinery. You're understanding? If you know, right, either Section 35 or depreciation, both I will not give you. So here you have claimed Section 35. So it is not a depreciable asset. So that is why I am doing all this thinking. Had it been depreciable asset, you would straight away conclude it is short term only. Okay, then you will start your computation, normal computation, guys. What's your full value consideration? You sold for how much? You sold for 4 lakh rupees. Now from this, what do you subtract? Your cost of acquisition. You purchased this asset for how much? You purchased this asset for 6 lakh rupees. So what's your net number? You're getting a negative 2 lakh rupees, guys. Now listen, in capital gains head, can you have a loss generally? Yes, in capital gains head, I can have a loss, guys. But in this calculation, when you sell a scientific research asset, you should only have a gain. If you have a loss, I will ignore the loss. You should only have a gain. If I had a gain over here, I would have taken the gain to my total income computation. But here, because it is a loss, I will ignore the loss. Understanding? Yes, this is a point which they have not mentioned in the solution, okay, but this is the provision. They have not mentioned in the solution because anyways it will not form a part of your total income, right? So it will anyways not form a part of your solution. So this anyways has to be only a note. So ideally they should have given a note about this in your solution, but they didn't. But know that if it was a positive number, I would have taken into the capital gains computation, okay? But because it is a negative number, that is why I am ignoring. This capital gains number should not be a negative number. Generally in capital gains, yes, you can have a loss. But here, the scientific research asset, in this situation, you cannot have a loss. Are we all following, guys? Yes. So now how many tax implications we have to do? We have to do only one, because capital gains we are ignoring over here. 4 lakhs we have to tax under PGBP. So add incomes not credited but taxable over here. Scientific research asset sale, we are taxing 4 lakhs. Guys, one explanation you've understood? Yes, the sale value or section 35, whichever is lesser will be taxed under PGBP. Then normal capital gains computation you will do. If it's a positive number, you will take it to your total income. If it's a negative number, you will ignore. Okay, now come to the next adjustment. That's all, guys, we're almost done. Only 2 more adjustments. Let's finish this nicely. Listen to me. Admin expenses includes 1,75,000 expenditure paid to a scientific research association, which means it is a contribution to outsiders. Listen to me. Under section 115 BAC, in section 35, will you allow in-house scientific research? In-house you will allow. Will you allow contribution to outsiders? You will not allow. So admin expenses includes 1,75,000 paid to Scientific Research Association. Guys, this is contribution to outsiders. It is not allowed. It is already debited in P&L. So how will you reverse the debit? You will reverse the debit by adding it back. So scientific research, contribution to outsiders, 1,75,000. I will add back. Okay, then the question says out of 1,75,000, 50,000 was utilized towards purchase of land. I don't care. See, once you contribute to outsider, no, what the outsider does with that money doesn't even matter. I will anyways disallow it fully. Okay, now comes my last adjustment. You remember we had bad debts recovered over here, 3 lakhs. About this they have given information, okay? Listen carefully. Okay. Question says he received 3 lakhs from a debtor, which was written off as bad. Long back in 1819, it was written off as bad. You've received 3 lakhs. Amount due from the debtor was 5 lakhs, out of which tax officer had allowed 3 lakhs as deduction in computing total income. Very simple adjustment. Just listen to me. What was the total debt? Total debtor amount. How much did we have to receive from him? 5 lakhs. From this, how much bad debts deduction did the income tax officer allow? He allowed only 3 lakh as deduction, guys. So can I say that still receivable amount is, even now receivable amount is 2 lakhs? Can I say this? 2 lakhs is still receivable. How much I received? How much I received? I received 3 lakhs. So out of 3 lakhs which I have received now, I received 2 lakh which was anyways receivable. No big deal in that. 2 lakhs was anyways receivable. I received that, this 2 lakhs. How much extra I received? 1 lakh. This is only bad debts recovered. Till here, did you understand? Very simple discussion. Pure logic, guys, pure logic. Debtor was 5 lakhs. I allowed 3 lakh as bad debts. So I still have 2 lakhs receivable. Out of 2 lakhs receivable, how much I received? 3 lakhs I received. How much extra I received? I was supposed to receive 2 lakhs only, no. But how much I received? 3 lakhs. So how much extra I received over and above 2 lakh? Extra 1 lakh I received. That extra 1 lakh becomes bad debts recovered. But what we did? How much we credited? We have credited 3 lakh rupees. How much extra we have credited? Extra 2 lakhs we have credited. How will you reverse extra credit? You will subtract. So, less incomes credited but not taxable. Excess bad debts recovered. The real bad debt recovered is how much? 1 lakh. How much you credited? 3 lakh. How much extra you credited? 2 lakhs. I'll reverse it. I'll explain one last time. Listen to me. I was supposed to receive 5 lakhs originally. 3 lakhs bad debts allowed. So I still have to receive how much? I still have to receive 2 lakhs. 2 lakhs is still receivable. How much I received? But I received 3 lakhs. I was supposed to receive how much? 2 lakhs. I received how much? 3 lakhs. How much extra I received? 1 lakh. So what is bad debts recovered? 1 lakh. But how much did we credit to the P&L? To the P&L we credited 3 lakhs. So how much extra we credited? 2 lakhs. So we'll reverse that 2 lakhs by subtracting it. That's it, guys. Come on now, add, subtract and tell me what is your net PGBP number now. How much is your PGBP number? Do you get 65 lakhs 20,000 net PGBP number? I'll take this to your main answer. IFO is only one income we have, 45,000. That's all. So the GTI will be 65 lakhs 65,000. This itself will become the total income also, because no chapter 6A. Already in multiples of 10, no need to do any rounding off. Then they asked us to compute tax also. Which regime are we following? 115 BSE. 115 BSE for all SSC's basic exemption limit will be 3 lakhs. Now tell me, do I have any special rate income inside this? Yes, I have lottery income of 45,000. So I'll have 2 columns, guys. How much is our normal rate income? 65 lakh 20,000. Then we have lottery income. So 115 BB. Lottery income we have 45,000. So first of all, we'll compute basic tax. How to compute basic tax? 115 BSE up to 15 lakhs. You anyways have to pay 1,40,000 plus 30% of the income in excess of 15 lakhs. And on lottery income, at what rate you compute tax? 30%. Go ahead, finish it. ₹16,46,000 here, 13,500 here. So your total basic tax will be 16,59,500. Then will you have 87A rebate? No 87A rebate, because income is more than 7 lakhs. Then will you have surcharge? But yes, I will have surcharge because income is more than 50 lakh. 50 lakh to 1 crore, 10% surcharge. 10% of what? Surcharge is always a percentage of income tax. So 165950. Then you will add cess. After adding cess, you will have 1898,468, and they asked for tax 1 second, 1659,500 plus 10% surcharge plus 4% cess, 1,898,468, which you will round off to nearest multiple of 10, 1,898,470. Had they asked for tax payable, I would have subtracted section 194B, TDS credit I would have subtracted, but this is tax liability, so I will stop with this number. Okay, now I'll show you the solution. Okay, the solution will have some ambiguities. I'll show you. See, in the solution, first mistake would be this one, 1,20,000 they would have taken. They should have taken how much here? They should have taken only 12,000. If you do this calculation, you will get 12,000 only. They put one extra zero over here. This is one problem over here. And the second problem is, 1 second, here. Second problem is, if you see, they've done the PGBP calculation, okay, and they've straight away shown IFOS. They've not shown anything about capital gains. Now be careful. If you have the old version of RTP, the same RTP they uploaded 2 times in the website. The first time they uploaded the RTP, they would have done one capital gains positive number they would have put over here. Positive 2 lakhs they would have put over here, which is wrong. So that is why they re-uploaded. What I'm showing you right now is the latest RTP version which is available on the institute website. Today if you download, this is how you will get. And in that, if you see, they have removed the capital gains number, but they should have ideally shown the loss. Okay, you can't put the loss in the computation, but at least some note or something they should have shown, which they have not shown. But please know that if you have downloaded the RTP earlier, first time when they uploaded, no, that time if you have downloaded the RTP, you will find one capital gains calculation over here which was utter nonsense. That they have correctly, thankfully, removed. This is your updated RTP which today only I downloaded from your website. Okay, so that's it guys, that's it with this question. The answer is different over here because 1,20,000 they took, we should have taken only 12,000. So you have 1,08,000 difference in your income number. Okay, so we'll close over here guys, we'll close with this question. That is it with your total income question, and you can trust me, the solution which I have given you is 100% accurate solution. Please trust me. Alright, so that is it with this question. I think we're good to close over here. Nice interesting question this was, especially the scientific research part. Alright, see, and we had that contribution to outsiders. No, this point, contribution to outsiders. What if assessee was following normal regime? Then contribution to outsiders you will allow. But the outsider is using this money for land. Is that okay for you? Yes. See, contribution to outsider is allowed, okay. Once you contributed to the outsider, what he is doing with your money, that doesn't even matter. It will be fully allowed anyways. So therefore, if it was normal regime, this 1,75,000 will be fully allowed. Because it is default regime, that is why we did not allow this 1,75,000. Okay, so with this, can I close my RTP discussion please? All the 10 questions we have seen, this RTP especially I would say has a lot of interesting adjustments. See, every time RTP does have some new questions, but this time's RTP, if you see, every question was interesting. Alright, so we'll close our RTP discussion over here. Okay, so let's begin the discussion of the MCQs part from your MTP1. MTP1 especially has some very good MCQs, alright, and I thought I'll do this for you because the descriptive part, at least you have the solutions, you will know how to arrive at the answers. But when it comes to the MCQs, they haven't given any computations, so you might get a little stuck, especially if you don't have 100% proper conceptual clarity. So that's why, with that in my mind, I wanted to work out the MCQs part for you. Let's read out the first one. The question says, Manisha is a research scholar pursuing her PhD. She is unmarried and her parents are living in Ahmedabad, Gujarat. Her paternal grandparents and other family relatives are staying in South Africa. So her parents are living in Ahmedabad. Multiple other relatives are staying in South Africa. She was in India with her parents till May 2020. So with this, I can say that she was born in India, because she was in India with her parents till May 2020. So she was born in India. So she becomes a person of Indian origin. Okay. Then after that, she went to London for further education. Okay. In October 2023, she returned to India. So October 2023 means previous year 23-24. So last year, not the current year, last year she has already returned to India. Then on 28th March 2024, which is again previous year 23-24 only, last year, she travelled out of India to Johannesburg in South Africa for her research project and Khadi business exhibitions. She returned on 1st October 24. So current year, when has she come to India? Current year, 1st October 24 only she has come to India. Last year itself she left India. Current year now she has come to India. 1st October 24 she has come to India. But the question says she returned. So can I say that she is visiting India or has she come to India forever? Returned indicates she's come to India with some permanence element. There's an element of permanence over here. So this is not visit, guys. She is not visiting India. She has returned to India. Okay, on 1st October 24. So if I ask you current year, how many days is she in India? What will you say? October, November, December, January, February, March. Totally she is in India for exactly 182 days, guys. Exactly 182 days. Okay. She came to India to participate in the 155th birth anniversary celebrations of Mahatma Gandhi. Now with this much information alone, I can find her residential status. So come on everybody, whenever we compute residential status, the first thing we check is special provision. But you can apply special provision only if some conditions are fulfilled. Condition number 1, she should be an Indian citizen or person of Indian origin. Yes, she is a person of Indian origin. Condition number 2, she should have visited India in the previous year. Is she visiting India, guys? No, she is not visiting India. She has returned to India. She has come to India with a permanence element. She is not visiting India. Condition 2 is not fulfilled. Special provision will not apply. So therefore, which provision will you apply now? The regular provision. Regular provision says basic condition 1, previous year you must stay in India for at least 182 days. Is this condition fulfilled? Yes, previous year she has stayed in India for 182 days, which means she is a resident. Now you will apply additional conditions. Additional condition 1 says 7 preceding previous years she should have stayed in India for at least 730 days. See guys, she left India for the first time only in May 2020. So before that full year she was in India only. So 7 preceding previous years, definitely she has been in India for at least 730 days. And the additional condition 2 says at least 2 out of 10 preceding previous years she should be a resident. Same reason, till May 2020 she has been in India only. So before that full year she is in India only. So before this every year she is a resident only. So both your additional conditions are fulfilled. Therefore your SSC becomes ROR. So what is the residential status of Manisha? What is the residential status of your SSC? She is an ROR. So that is the conclusion of this entire para till here. Then the question says, in this connection she attended numerous events held all over India while also holding exhibitions for a textile business in Khadi, the fabric that breathes, the livery of freedom as showcased by Mahatma Gandhi. She won accolades and awards, gifts and donations in the course of showcasing her work. You have been provided with the following data in respect of her receipts and income. Let us have a look at the information given one by one. First of all, she is receiving scholarship. Scholarship is going to be fully exempt, guys. Any scholarship relating to education, any scholarship relating to research work, this is going to be fully exempt. So yes, this scholarship relating to research work, it is going to be fully exempt. Nothing more to discuss about over here. Then comes the second subdivision, gross receipts from exhibitions held in South Africa in collaboration with leading fashion house. Tell me, is she carrying on a business or is she carrying on a profession? Is she carrying on a business or is she carrying on a profession? She is carrying on a business over here, guys. She has a business relating to these Khadi products and all, where she is, exhibiting the goods in South Africa in exhibitions and all. So what is her turnover? Gross receipt from exhibitions in South Africa. So 10 lakhs is her turnover from exhibitions in South Africa. Exhibitions in India, 12 lakhs. See guys, she is ROR. So global income is taxed for her. Even South Africa income you will consider, right? So this is her turnover from the business. Gross receipt from exhibitions in India, gross receipts from exhibitions in South Africa, gross receipts from sale of honey, 1,05,000. All of these are her turnover numbers. All the three are her turnover numbers. Don't get confused. They've used the word gross receipt. But this is not professional income, guys. She is running a business. So these are all her turnover numbers. Okay. Then gross receipts from sale of handmade khadi designer fashion accessories, 2,25,000. So even this is her turnover, 2,25,000. Then the question says, gift from father, sister, whom she visited in Johannesburg, South Africa. Gift from relative is exempt. Relative means what? If I am the assessee, it will include my parents, grandparents, great-grandparents and so on. It will include my children, grandchildren, great-grandchildren and so on. It will include my brothers and my sister. It will include my parents and their brothers and sisters. It will also include my spouse. It will also include my spouse's brothers and sisters, my spouse's parents, grandparents, great-grandparents and so on, my spouse's children, grandchildren, great-grandchildren and so on. It will also include the HUF where I am a member, and it will include all their spouses. Okay, so here I received a gift from whom? From my father's sister. So if I am the assessee, my father's sister is going to be relative, guys. So this gift is going to be fully exempt because father's sister will be considered as relative. Then cash gift receipt from friends. This is gift from friends, guys, in Gandhi Gujarat Seva Samaj with whom she stayed while in Johannesburg. Gift from friends. Actually, it is taxable, but it is within 50,000, guys, and therefore this is going to be exempt. Then share of income from HUF, even this is going to be exempt. Then cost of material for exhibitions in South Africa. See, guys, over here whatever information we put were about her turnover, her receipts. Now they are giving us information about her expenses. So cost of material expense is 12 lakh. Cost of handmade khadi designer fashion accessory is 1 lakh. Other expenses 4 lakhs. Cost of honey 55,000. So total how much expense she has incurred. Add up all the expenses, guys. Her total expense is 17,55,000. 17,55,000. So if you add up, what's her total turnover? Tell me this also. Total turnover is 25,30,000. Okay, 25,30,000 is a total turnover. And if you subtract her expenses, how much expenses? 17,55,000. Expenses, if you subtract, what will be her PGBP? Her PGBP will be 7,75,000. Okay, but if you notice, she's an individual, she's a resident, she's carrying on a business. It is not business of applying, hiring, leasing, goods, carriages. It is not agency business. Her turnover is within 2 crores, within 3 crores. So therefore, section 44 AD will also apply for her. As per section 44 AD, presumptive taxation, her PGBP will be either 6% or 8%, guys, depending upon in what mode she has received her turnover. So let's continue to read. The question says, Mr. Patel of South Africa gave her a check of 5 lakhs, favoring Gandhi Smark Trust as donation to the trust. She was requested to hand over the check to the trust's office at Ahmedabad. So Mr. Patel has given her a check and she is going to give the check to the trust. So is it her income, guys? It's not her income because she has received it and then she has to give it to somebody else. So this I will fully ignore. Then the question says Manisha does not manufacture. So therefore no additional depreciation. She is not a manufacturer. Then all financial transactions are in account payee check and TDS has been deducted wherever applicable. So all transactions are in check. So how will you compute 44 AD now? 44 AD, 6% of the turnover which you have realized in specified mode. So account payee check, specified mode. So 25,30,000. See, 44 AD, how do you compute PGBP, guys? 6% of that turnover which you have realized in specified mode on or before section 139(1) date. Here the question says all transactions are in account payee check. So entire turnover has come in specified mode. If at all I have any balance turnover, there only 8%. But here entire turnover will fit under this category. So 6% of the turnover, guys. So 25,30,000 into 6% will be how much? 1,51,800. Now see, if my assessee does not follow 44 AD, PGBP is 7,75,000. But with 44 AD, it is 151,800. Obviously, what will you suggest your assessee to follow? 44 AD 151,800 would be the PGBP. Okay, then the question says her paternal grandfather is Karta of HUF. Her grandfather comes to India for 6 months every year. HUF is managed outside India. All decisions of HUF are made outside India. So what is the residential status of HUF, guys? See, HUF, is it a resident or is it a non-resident? It depends upon where is the control and management. Question says control and management is fully outside India. So HUF is going to be non-resident. See, only if HUF is a resident, then to check whether ROR or RNOR, this is where I consider Karta's information. But is your HUF resident or non-resident? For that, Karta is irrelevant for me. So here the whole management and control is outside India. So HUF is a non-resident. Even little bit control and management, if it was in India, HUF would have become resident. If HUF was resident, to find out ROR or RNOR, for that I would have taken the help of Karta's information. But here HUF is non-resident. So no question of ROR, RNOR. So no question of thinking about Karta. Then Manisha has opted out of the default regime, which means she is following the normal provisions. Okay. Now what is the residential status of HUF? HUF is a non-resident. We have already done that checking. Then what is the taxability of the gift received by Manisha from father-sister? Remember, this was exempt because father-sister was relative. And what about her friends from the Gandhi Gujarat Seva Samaj? Even this was exempt because it was only 27,000. It was within 50,000. So both the gifts were exempt, guys. So which will be your correct answer? Option D. 51,000 will be exempt, gift received from relative. 27,000 from friends will not be taxable because it does not exceed 50,000. Yes, option D. Then they are asking us total income of Manisha if she wants to maximize tax savings. What will be her total income, guys? She wants to maximize tax savings. She is not following 115 BAC. Normal regime only. What are her incomes? Scholarship is anyways exempt. Then from her business, what is better? Obviously 44 AD is better because it is resulting in lesser income. So 151,800. Then what are her other incomes? Gifts are all exempt. So only one income she is having, which is this 151,800. So what is going to be her total income? Option C, 151,800. Okay, here the whole trick is that you should remember about 44 AD. Otherwise, what students will do is they will take this number, and this number is given in the options correctly. The whole objective of me doing this question is through this question to remind you about 44 AD. If assessee is carrying on a business, if it is not agency business, not the business of plying, hiring, leasing goods carriages, then you should be thinking about 44 AD. Provided turnover is within 2 crore, within 3 crore, as the case may be. Okay, so this was your very first question, your first case study based MCQ. Come to the second question now. Second question will be a nice chapter 6A learning for you. Okay, let's read the question. The question says Mrs. Ritu is a retired government employee. She was born on 1st April 1942. So current year, is she a senior citizen, guys? Yes, in fact, 2024 minus 1942, 82 years. She's actually a super senior citizen. See, she is an individual, okay. She is at least 80 years old. Okay. If she is a resident, then she will become a super senior citizen. Just because she is at least 80 years, on this basis alone, don't conclude she is a super senior citizen. She is an individual, she is at least 80 years. Now, if she is a resident, only then she will become super senior citizen. Okay. Then the question says she is residing in Delhi. She stayed with her elder son Nakul from 1st May to 15th October, who is residing in Australia. So, 1st May to 15th October, she is in Australia. So, how many days she is in India, guys? How many days she is in India? April 30 days. Should I count 1st May? No, because 1st May to 15th October she is in Australia. So I will not count 1st May. Then when is she coming back? Till 15th October she is in Australia. So she is coming back to India only 16th October. So October how many days, guys? 31 minus 16 plus 1. You understood why I did like this? Because till 15th October Australia. 16th October only she is coming to India. So 16th to 31st, both days included I am counting. Till 15th outside India, 16th onwards in India. Then November 30 days, December 31 days, Jan 31 days, February 28 days, March 31 days. So totally how many days is she in India? 197 days, do you get? Yes guys. Then she stayed in India for 361 days during 4 preceding previous years. So with this information I can find her residential status. First I will try special provision. But I can apply special provision only if 3 conditions are fulfilled. Condition number 1, she should be Indian citizen or person of Indian origin. Question says she was born in India. So therefore yes, she is a person of Indian origin. Condition 1 fulfilled. Condition 2, she should be visiting India. Is she visiting India guys? No. She stays in India. She is visiting her son in Australia and she is coming back. Is she visiting India? No. So special provision will not apply. The regular provision will apply. Regular provision says basic condition 1. In the previous year you must stay in India for at least 182 days. Fulfilled guys. Assessee is staying in India for 197 days. So clearly basic condition 1 is fulfilled. Now after this what will you check? The 2 additional conditions. Additional condition 1 says 7 preceding previous years she should be in India for at least 730 days. At least 730 days. And additional condition 2 says in at least 2 out of 10 preceding previous years she should be a resident. Have they given any information about the last 7 years, the last 10 years? No, the question has just given us information about 4 preceding previous years. So is she ROR? Is she RNOR? We don't know. We can't conclude. Okay guys, now but then however, this much we have concluded that 1 basic condition she has fulfilled. So this much we can conclude that she is definitely a resident. Is she ROR or RNOR? I don't know. But she is a resident. So she is at least 80 years. She is an individual. She is a resident. So I can conclude that she is a super senior citizen. Alright guys. Yes. So whether she is ROR or RNOR, I don't know. 1 basic condition is fulfilled. She is a resident. So she is a resident. She is individual. She is at least 8 years. So yes, she is a super senior citizen. Okay. Then listen. During the previous year 24-25, pension of 715461 is credited in her account with SBI Uttam Nagar branch after deducting TDS 14655. Pension income guys, retired employee, which head of income? Of course, we will have the salaries head of income. So under salaries head of income, how much is her pension income? 715461. But this is after deducting TDS 14565. So her gross salary, her gross pension will be 715461 plus 14565. Okay, and later in case we have to compute tax payable, we have TDS credit. How much TDS credit do we have? This much was deducted against her, no? 14565 TDS credit we have in case we have to compute tax payable later. Then the question says she received interest of 4352 on her savings account with SBI during 24-25. Savings account interest, which head of income? IFOS. So IFOS savings interest from bank 4352. Now savings interest 4352, any chapter 6A comes to your mind? Chapter 6A, you will first think about ATTTB. Very good. And ATTTB will apply for you because assessee is a senior citizen, super senior citizen guys. So ATTTB will apply. ATTTB will cover savings interest also, FD interest also. So this 4352 you will get chapter 6A ATTTB also. She also received 67,500 net of TDS on FD with Canara Bank. So FD interest also will come to IFOS head guys. But 67,500 is net of TDS. So you will have to gross it up. Section 194A, TDS rate is 10%. So 67,500 into 100 by 90, grossed up will be 75,000. So FD, listen guys, FD interest, savings bank interest, both will go under ATTTB. But under ATTTB, maximum how much you can enjoy? Maximum only 50,000 you can enjoy. Okay. Now, This is 192 TDS credit, TDS on salaries. We have one more TDS credit now, 194A, FD interest. Just now we have grossed up, no? So we have TDS credit over here, 10%, 7,500. Okay, so this is about your first para of the question. Then what else? She purchased 2 life insurance policies for her son and married daughter. Details are given. Self, spouse, children. Life insurance premium you will get deduction under which section? Under ATC. Okay, so for her son, Mr. Yuvan, she has taken policy on 15th October 2020. So policy is taken on or after 1st April 2012, guys. So maximum how much premium you can pay? 10% of sum assured. So this is your sum assured. This into 10%. Maximum you can pay only 98,466. You have paid 1,388. But sorry, assessee, ATC only this much I will allow. Maximum is 10% of sum assured. Similarly, for the daughter, she took policy on 20th September 2020. Even this is on or after 1st April 2012. So maximum you can pay 10% of sum assured, 20,000 you can pay. But we have paid 17,000 only, which is within the limit. So total ATC, how much deduction will you get? Total ATC 115,466 you will get total under ATC. So I'll take this again over here. So under chapter 6A, section ATC, we have 115,466. Now see, ATC will go to ATCCE. ATCCE says ATC plus ATCCC plus ATCCD subsection 1 should not exceed 1,50,000. It is within 1,50,000 only, so fully allowed. Till here also done. Then the question says, last para is the most interesting para. The question says, she took medical insurance for herself, for which she paid 35,000. Which section comes to your mind? Section ATD. In ATD, how many columns will I draw always? 2 columns, guys. You will have 1 column for family. In family category, you will have self, spouse and dependent children. And then you will have the parents category. Now, for family category, what will the maximum limit be? Tell me. Generally 25,000. But she herself is senior citizen, guys. So the limit will become 50,000. Now, if she is a super senior citizen, her parents will definitely also be super senior citizens. So parents category also the limit will become 50,000. Okay. Now, how much premium is she paying for herself? For herself, she is paying 35,000. Okay. She has paid by account payee check. Is that okay for you? Yes. Section ATD says irrespective of the amount, you should make the payment by non-cash mode. Yes, assessee has made the payment by non-cash mode. Good only. Then the question says she incurred 7,500 towards preventive health checkup of herself and her husband in cash. Preventive health checkup you can have in any mode, you can have in cash also, no problem, but maximum 5,000 only I will take. So self and spouse family category, guys, 5,000 only we will put here. Then the question says she also incurred medical expense of 25,000 in cash in the month of Jan 25 for her husband. See, yes, medical expenditure also we consider in ATD, but you should make the payment in non-cash mode. No, you have made the payment in cash. So because you have made the payment in cash, this I will not consider, because ATD says irrespective of the amount, make the payment in non-cash mode. Payment is in cash, so I will not consider. Then in the month of March 25, she incurred medical expenditure for herself, which is paid by account payee's check. See, medical expenditure is allowed in ATD, but there are conditions. Condition number 1, the patient should be senior citizen or super senior citizen. She has paid medical expenditure for herself, and yes, she is super senior citizen. Condition number 2 is that the patient should come under the family category or the patient should come under the parents category. She has paid for whom, guys? For herself, which means yes, we are coming under the family category. Then the payment must be made in non-cash mode. In what mode have you made the payment? Account pay check. Yes, even that condition is fulfilled. But there is one important condition, that in the name of the patient, you should not have any medical insurance policy. Now in this question, if you see, in her own name, she has a medical insurance policy, guys. She has paid medical insurance for herself, which means in her own name, she has a medical insurance policy. So this condition is not fulfilled. So therefore, this medical expense of 10,500 for herself will also not be eligible. Understood, guys? You can take medical expense only if in that person's name there is no insurance, there's no medical insurance policy. Here in her name there is a medical insurance policy, so medical expense will become ineligible. So total ATD will be how much over here? 40,000, which is well within the limit of 50,000. So full ATD I will allow, guys. ATD 40,000. Okay, then what else? She has given a wristwatch of 10,000 on her husband's 85th birthday. This indicates to us her husband is also a super senior citizen. He is a resident of India. Now come on, let's have a look at the questions. What would be the amount of chapter 6A deduction? Chapter 6A, come on guys, add up. Total chapter 6A is how much? We have already done all the thinking. It will be very easy. Total chapter 6A you're getting 2,05,466, which will be option A. Then they're asking us what would be the GTI of Mrs. Ritu under normal provisions. Normal provisions means what? Not as per 115 BSE. Normal provisions, GTI only they're asking us. Okay. So from salaries, how much standard deduction you will allow? Normal regime, 50,000 standard deduction only you will allow. So your taxable salary will become 6,80,026. Total IFOS is 79,352. So they are asking only GTI, no other income is there. So total GTI will become 759,378, which is option C. 759,378. They asked as per normal regime, only two heads of income we have, salary and IFOS. Then they are asking us what would be the total income of Mrs. Ritu if she pays tax under 115 BSE. So as per the default regime, they are asking us the total income, guys. So come on, what will change? First of all, salaries head, how much standard deduction you will get now? So this time you will get standard deduction of 75,000. So your taxable salary will be 6,55,026. 6,55,026. So your gross total income will be 7,34,378. And in 115 BSE, will you get these kind of chapter 6As, guys? Will you get this ATC, TTB, ATD and all? You will not get. So your final answer will be 734,378, which you will remember to round off to the nearest multiple of 10, 734,380. This would be your total income under 115 BSE. 734,380 here, guys. Option A. Okay, so nice interesting question. Main focus over here was chapter 6A. Chapter 6A, especially section ATD. Alright, so can we close this question? Simple straightforward question, question number 2. Now come, I'll take you to question number 3. Your third MCQ question, an independent MCQ question, but this is a kind of an MCQ question which if you have not done before your exam, if it comes in the exam, it may take a lot of time for you to understand what to do. So that is why let's discuss this once. So the question says in 24-25, Mr. Arun has transferred the following long-term capital assets. They themselves are saying it is long-term capital asset. Okay. How many assets are you transferring? Residential house property, jewels, 2 assets you are transferring. Full value consideration is given to us. Cost of acquisition is given to us. Date of transfer is also given to us. Mr. Arun bought a new residential house property on 1st April 2023. So you sold a house, you sold jewels, you bought a new house on 1st April 2023 for 1 crore rupees. Then on 28th February 2025, he deposited 3 crore rupees in CGD account, capital gains deposit account. Then on 1st May 2025, Mr. Arun has withdrawn the 3 crores from capital gains deposit account. He acquired a residential house property. So he has purchased a new house worth 2.5 crores. What would be the capital gains in the hands of Mr. Arun for 25-26 if expenses in connection with transfer of jewelry. For jewels alone, we have the expenses for transfer 2 lakh rupees. Are you ready? Can we take this up? I'll bring this to your classroom notes. We'll straight away discuss this over here, guys. Capital gains calculation. Right. Now tell me, how do we start? Usual steps, guys. Whether MCQ, whether full-fledged question, I'm going to do my usual steps. We always start with capital asset transferred. And here we're transferring 2 assets. So period of holding also I'll do together itself. What are we transferring? Residential house property. When did we buy? They didn't mention the date of acquisition. But what is the date of transfer? 25th November 2024. You will pause at this stage. You will check, oh, it is on or after 23rd July 24. So in section 50 AA, you will have 4 assets. But tell me, is it any of those 4 assets? Is it bonds? Is it market linked debentures? Is it units of debt oriented mutual fund? Is it unlisted debentures, unlisted bonds? None of it. 50 AA will not apply. Then what will be a relevant period of holding? Only 2 you will have, 12 and 24. Immovable property, 24 months. Then will you get indexation benefit? No indexation, guys, because it is after amendment. And lastly, if at all you have to compute tax, you will have only 2 tax rates, 12.5% and 20%. Okay. So this period, is it more than 24 or not? We don't know. We don't have the date of acquisition. But the question says very clearly these are long-term capital asset. So it has to be more than 24 months. It has to be long-term capital asset. And it's a house. Therefore, definitely 112 only. Okay, then one more asset we are having jewels, same thing. We don't know the date of acquisition. We only know the date of transfer. It is 5th Jan 2025. Again, same thing only, even over here, the date of transfer is on or after the amendment. So same 4 points only will apply even over here. Now this is clearly more than 24 months, guys, because the question says it is long-term capital asset, section 112. Okay, guys. Now I will start my usual computation. So I have 2 assets over here. I have residential house property and I have jewels. So we will start with full value consideration. What is a full value consideration? Number C is given over here. We have 8 crores for residential house property, 3 crores for jewels. From this we will subtract expenses on transfer. They have given us expenses on transfer only for jewels. For jewels it is 2 lakh rupees. So therefore what's your net number now? Same 8 crores for residential house property. For jewels alone you will have 2.98 crores. Okay, then cost of acquisition, 2 things I will ask you. Will grandfather clause apply? That 112A long-term capital asset? No. Then will you index the cost of acquisition? No indexing, guys, because we've already concluded over here, no indexation, because it is after the amendment. So I'll take the cost of acquisition as it is. We have 6 crores here and we have 2 crores here. So no cost of improvement also. So our capital gains as of now will be 2 crores and 98 lakhs. This will be your capital gains, your LTCG as of now. Till here okay, till here comfortable, till here all fine. This is, one second. Listen. So this is where the most interesting part of the question begins, guys. Now my assessee has sold house, he has sold jewels, and he is purchasing how many things? See, he is doing 3 things, okay. First he is buying, we'll do one by one, okay. First of all, he is buying this new house. But when did he buy? On 1st April 2023. See, if you want section 54 exemption, if you want 54F exemption and all, you should purchase 1 year before transfer or 2 years after transfer. You have purchased on 1st April 23. You have purchased even before 1 year. You have not purchased during 1 year before transfer. So this will become ineligible, guys. Are you getting this point? Yes, you will consider, you will allow, see, assessee sold a house and bought a house. So you will think about section 54. Assessee sold any long-term capital asset other than house and assessee bought a house. You will think about 54F. So in 54 also, in 54F also, in both you have a common point that yes, you can purchase a new house or you can construct a new house. If you are purchasing, you can purchase 1 year before transfer or within 2 years after transfer. Here we have purchased before both the transfers. But did you purchase during 1 year before transfer? No, you've purchased even before 1 year. So therefore this house will become ineligible. Okay. Then listen, assessee put 3 crores in CGD account. Then assessee withdrew the money from the CGD account and assessee then put the money into a new residential house property. Now see, when does the CGD concept come into the picture, guys? CGD concept comes into the picture if the assessee is going to buy the new asset after the 139(1) date. Only then it makes sense to put money into CGD account. Are you understanding? CGD concept comes into the picture only if you are going to buy the new asset after the 139(1) date. But here see, when is your assessee buying the new house? On 1st May 2025 itself. See, your year is 24-25, okay. What are your 139(1) dates? 31st July 25, 31st October 25, 30th November 25. Assessee has purchased the new house on 1st May 25, which is before 139(1) date. So is CGD concept even required? CGD concept itself is not required. Understanding the right way of understanding this concept. CGD concept comes into the picture only if you are going to buy the new asset after the 139(1) date. Only then CGD concept comes into the picture. But here, when are you buying the asset? On 1st May 25, before 139(1) date itself you are buying, guys. So CGD concept itself doesn't matter to me now. So what matters to me now? Only one thing will matter to me, guys, and that is my assessee has purchased a new house for 2.5 crore on 1st May 2025. Now check, did he purchase within 1 year before transfer or within 2 years after transfer? Yes, this is the date of transfer. He has purchased within 2 years after the date of transfer. Now I will give section 54 exemption also, 54F exemption also. Why section 54? Because assessee sold a house and purchased a house. So I will give section 54 exemption. Why 54F exemption? Because assessee has sold any long-term capital asset other than house and has purchased a house. I will give 54F exemption also. But which is more beneficial, guys? Section 54 is more beneficial because in 54F, because of the formula, only proportionate exemption you get, but 54 full exemption you get. So 54 is what I will do first. How much is for the new house? 2.5 crores, 2 crores exemption I'll give over here. How much more are you left for the house now? Total 2.5 crores, 2 crores you've already enjoyed over here, 50 lakhs you're still left. In 54F, what's the formula? The formula is amount invested in the new asset into LTCG by net consideration. Amount invested is actually 2.5 crores, but you have already taken how much exemption? 2 crores. How much are left now? Only 50 lakhs. What is the LTCG? 98 lakhs. What is the net consideration? 2 crore 98 lakhs. So how much do you get now? You will get one weird number. You will get 16,44,295. This is your 54F exemption. Okay. Now calculate taxable LTCG 0 and here 81,55,705. You're getting it. 3 things assessee did. The first house is ineligible because it was purchased even before 1 year. CGD concept, I don't care over here because CGD comes into the picture only if you buy the new asset after the 139(1) date. Here you are buying the new asset within 139(1) date. So on this basis itself, I will give you the exemption. Total 2.5 crores you put in the new asset. First, I will give you section 54, 2 crores. Section 54 maximum, how much exemption you can enjoy? Maximum 10 crores you can enjoy. This is within 10 crores only. So I gave you 2 crores fully. Then in section 54F, it's formula based. In formula, amount invested can be maximum how much? Amount invested can be maximum 10 crores. This is within 10 crores only. So applying the formula, this is your 54F exemption. So what's your taxable LTCG now? 8155705. Option B becomes your correct answer. Alright, so this was your capital gains MCQ. This MCQ is interesting because 3 things assessee has done, but out of the 3 things, only 1 thing was even relevant. Okay guys, and now I'll take you to the last MCQ question. While deciding the liability of an individual to deduct tax on payment of fees for professional services. Tell me guys, TDS on professional services with section 194J. Will you consider the amount paid to professional? Yes guys, because only if it is more than 30,000, only then TDS will apply. Then, will you consider turnover of the financial year immediately preceding the financial year? That is, will you consider preceding previous year turnover, preceding previous year gross receipt? Yes, it's an R hijack section you will consider. Will you consider the amount of fees for professional services? Yes. But will you consider turnover of the financial year? Will you consider current year turnover? Will you consider previous year turnover? You will not. So which of the following is immaterial? Which will be your correct answer here? Option C. Current year turnover is irrelevant. I only need preceding previous year's turnover. I don't need current year's turnover at all. Alright, so that is it with question number 4 guys. So these were your 4 MCQs in your MTP1 that I wanted to discuss with you. All clear? Yes. So with this, I think the whole agenda that I had for you, we were able to complete on time perfectly. Especially the MCQs part, I'm hoping you're having nice clarity guys, because you have a nice interesting MCQs. Alright, so with this, I think we're good to close. I hope you got benefited from this in some way or the other. In case you did get benefited, please do let me know. Alright, and I think with this, we are good to close. Thank you guys.